The equity markets got very excited at the end of September and the beginning of October, thinking, you know what, the Fed is done.
The Fed is engineering an economic slowdown. The economic slowdown impacts earnings.
We definitely are seeing higher interest rates bite in a more meaningful way.
Growth is likely to be a lot worse than it has been over this past year.
I don't think even in a slower growth environment from an economic perspective, we're likely to see another big hit to earnings.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market on the S&P totally unchanged. In so many ways, the week begins in 2 hours and 30 minutes. US CPI just around the corner. Then it's on to the Federal Reserve tomorrow. And then it's on to retail sales. For me, for everyone around this table, the biggest story overnight, a toy maker cutting 20% of the staff, TK, 2 weeks before Christmas.
It's 2 weeks before Christmas, and it's about the new reality out there, and it does fold into all the economic data. It folds into the new reality of a real interest rate. There's structural issues with the toy industry, and that Brammel's kids only want apps. They don't want toys. Mom, we don't want toys. How strange is that? My kids don't want toys. They just want apps or, cash for makeup. But maybe the Hasbro should go into the makeup business. But the answer is structural, but there's also this question of cyclical and the mystery of this holiday season.
Elisa, does it get any more bearish than this from Hasbro? This quote right here: the market headwinds we anticipated have proven to be stronger and more persistent than planned.
It doesn't get more bearish. The question just is, bearish for who? Is it just bearish for the toy industry, or is it bearish for the broader society, considering the fact that we are heading into Christmas time? I mean, that's kind of sad that people aren't buying toys. But I have to wonder whether it's just that people have so much clutter and they can't move out of their homes. They already have so much stuff that they need to get rid of. So I just wonder how much that's also the sort of hangover from the pandemic, when everyone bought as much that they could to try to occupy their toys.
The hangovers are public. $5 billion in revenue. 6,400 employees. This is a microcap by today's standards. The fact is there's a lot of other companies like this struggling. And again, I go back to there was free money to get along, and with this inflation report today, it's going to be an update on how free the free money is.
Well, never mind the handover. I think in many ways in the equity market we're still drunk. Year-end price targets on the S&P 500, Citi, 5,100, Oppenheimer, 5,200. What did we hear from Ed Yardeni yesterday? 6K.
Precisely, 5,800. He rounds it up in the headline to 6,000 out 25 months. Consider this. We are 1% away from a Standard & Poor's 500 total return record high. We are at a Dow Jones industrial average total return record high, and there's people still telling me this is a bear market.
Andrew Hollenhorst, Citi, nails it. One challenge for the Federal Reserve, one question, one major decision for Chairman Powell, Bramo, whether to accept the easing of financial conditions since early November.
And that's really the key question. What's he going to do to push back? And I have to say that Steve Englander over at Standard Chartered came out with this, which I thought was fascinating. What is the language that the Fed could say that could torpedo market activity? A statement that cuts can come if inflation progress continues to be made would be a screaming endorsement of the easing in financial conditions. Expect a huge rally. If he goes the other way, expect stasis, because nobody believes that he's actually going to be hawkish. And that, I think, is the asymmetry right now in markets.
I think the data is more important than the verbiage. And Chairman Powell's verbiage will be adjusted by what we see at 8:30 today.
England are expecting a friendly Chairman Powell, not validation of current market pricing, a friendly Chairman Powell. Here's your equity market price action. Here are the scores. On the S&P, we look a little something like this, totally unchanged after 2 days of gains on the S&P. Yesterday, a day of gains on the S&P 500, even with some tech weakness. This morning, yields down again, Monday, then Tuesday. We're down about 4 or 5 basis points here, Lisa, 418.72.
What we're watching today, the main event, and as you said, the week starts in about 2.5 hours, 8:30 a.m. U.S. November CPI. All eyes are going to be on core. We expect basically no change, no increase in inflation month over month when it comes to the overall headline number. This is being driven by gasoline, by oil prices, and other types of commodities. The key is 4% is where all non-energy and food prices are stuck in terms of inflation, and that is concerning for the Fed. 1 p.m., the U.S. is selling $21 billion of 30-year bonds. You missed the auctions yesterday, John. I was trying to talk them up. Tom kept talking them down. They were interesting. They did tail, but they were not.
One was bad, right?
They both were not particularly exciting, but they didn't really have a huge impact on the market, which I thought was newsworthy in and of itself. 30-year auction should be more exciting considering the fact that last month...
We had a board. The Wall Street Journal did an article on the auctions. We featured it. Grandma was glowing.
And then also later today, Ukraine President Vladimir Zelensky
This is going well.
Is in Washington, D.C. today. He's meeting with President Biden and others, kind of the last-ditch effort to try to get something. A lot of people are saying it's kind of futile, though.
I want to insert here quickly the Washington Post, Ellen Nakashima, with a devastating article on Chinese espionage this morning. That will be the talk of the day in the world of Anne-Marie Horton.
It's good to be back. It's good to be back. Keep it together, Bramo. AMH coming up a little bit later this morning. Let's kick off the market conversation. We can do that with Russ Kostrick, Global Allocation Fund Portfolio Manager over at BlackRock. Russ, let's start with the data at 8:30 Eastern Time. What are you and the team looking for?
Good morning, Jonathan. I think we're going to be probably close to the consensus. Inflation is slowing, but it's slowed in an even pace. We saw that last week when we talked about non-farm payrolls and hourly earnings, that the economy is moderating, but it's not a straight line down. I think inflation is going to give the Fed the ability to go on pause. But again, the big question is, since the market's already discounted that, is when are they going to start cutting? There we do think some of the expectations have gotten a bit too aggressive.
Are we, Russ Kostrich, finding bull market exuberance here? I mean, you've got such a balanced approach at BlackRock. And my answer is, to take it from Robert Schiller at Yale, is it an exuberant December? Are we there yet?
Well, there's been exuberance. I mean, in November alone, we were 10, 11% off of the October lows. Now, again, all that did is get you back to where you were in July. But I do think that the market is more nuanced than that. I mean, you clearly have had a handful of stocks that have led the market all year. They posted stellar gains. Their valuations are not cheap. But you go beyond that. You look at the other 493, and suddenly things look very different. You've got most of the sectors trading at or below their historical median. You leave the United States, you look at international markets, they're not nearly as expensive. So I don't think this is a bubble. I don't think we're seeing the irrational exuberance we all spoke about more than 25 years ago. But you do see a market that is now discounted a soft landing, which is very different than where we were back in March.
Then how do you allocate? I mean, with that very nice summer you gave us, and we're away from exuberance, and there's people that still think it's a bear market. How do you allocate out 6 months or 12 months?
So I think there are a couple things you can do. The first of which is, again, I do believe that there are opportunities in the equity market. So you have your equity exposure, but you're shifting it away from just a handful of companies, although I do think they still have a place in your portfolio, but it's more diversified. Emphasize quality, emphasize consistency in companies, because as the economy slows, those are the characteristics people tend to value. And then finally, and I think this is something we haven't spoken about in a long time, use carry, use income to drive return. You can build a 6-7% bond portfolio, something you've not been able to do in many, many years. That becomes a bigger part of return in an environment where equities have already run quite a bit this year.
So just to put the sort of figure on that, is it 60-40, more like 50-50, or is it more like 70-30 with a greater credit exposure?
I think it's probably still closer to 60-40, maybe 65-35. But what I think you're doing differently is where 10 years ago, you might have just had that slug of long treasury duration, which wasn't giving you a ton of yield, but was giving you a very good hedge. Today, that bond portfolio has got more credit in it. There's more spread product, more securitized, a bit of EM. It is a more diversified portfolio with a higher yield potential than you might have had 5 or 10 years ago.
Russ, can we just finish on looking ahead to the Federal Reserve tomorrow after we get this CPI print? When this comes out, we'll get the statement, we'll get the summary of economic projections. Can we go straight to the dots? And the 2024 dots specifically, at the moment it implies 1 cut. Most people assume it's going to come down maybe another 2 and imply 3. If it implies 3 cuts, based on where the market is pricing, how do you think we would take that tomorrow if we didn't fully validate market pricing but basically got the direction right?
I think the market will be okay with that because, again, there's been a gap between what the investor community is expecting, what the Fed is actually suggesting the dot plots for most of the year. That said, even if the Fed goes in that direction, I wouldn't take that as validation that the Fed is going to cut as aggressively in 2024 as the market is discounted today.
Russ, the 10-year inflation-adjusted yield, the real yield, one measure I have under 2%, 2.02%, opens this morning a 1.98. The recent low is 1.94. Where should that inflation-adjusted yield be given the soup of 2024?
I think it should be pretty close to where it is. We were just having this discussion a few days ago. I don't think it's crazy that you're going to go through 2024 and the 10-year yield is not going to be materially different than where it is today, both the nominal and the real. So I think we've actually priced in a reasonable scenario going out the next 6 to 12 months.
One thing that I was noting from Bank of America is that the most consensus theme right now is rate cuts next year. The most counter consensus right now is higher for longer. How much do you lean against the consensus, given the fact that you don't see the weakness that would necessarily cause the default cycle that would really disrupt some of the trades that you find most attractive?
I think we have to define what higher for longer is. If higher for longer is going to be higher than we had in the post-GFC environment, then I think yes. I don't think we're going to go back to that equilibrium, in part because it's not clear that inflation is going to go back to not only the level we saw in the post-GFC environment, but also the stability. Part of why yields remain so low and that term premium was so low for so long is there was no volatility to inflation. And that has changed. And while I think inflation and vol are moderating, I don't think we're going all the way back to where we were in 2019.
Inflation data 2 hours and 20 minutes away. Russ, thank you. Russ Kostrick there of BlackRock. Looking out for the economic data, three-part story this week. Economic data, CPI, then on to the Federal Reserve, then after that, U.S. retail sales. TK, I know you're super focused on retail sales in America.
70% of the economy into me. And Gina Martin Adams, John, on Friday, I thought was absolutely brilliant. Don't forget the real economy. Are we doing well in the equity markets? Because of the real economy? Well, guess what? Retail sales is the nominal, not inflation-adjusted thermometer of that.
In just a moment, we'll catch up with Terry Haynes as well of Pangea Policy. We need to talk about the latest in Israel. The president hosted a reception yesterday evening for Hanukkah and saying this: we continue to provide military assistance until they get rid of Hamas, but we have to be careful. They have to be careful. The whole world's public opinion can shift overnight. We can't let that happen. The problem for the president, it's shifting domestically already in America. You go to a recent poll, Lisa, half of those surveyed by Gallup late last month said they approved of Israel's military action in Gaza. That's 45% of Americans said they disapproved. Now, within that, 63% of Democrats disapproved. That's the reality for this White House going into next year.
When I read that comment from President Biden, I wondered if he was talking to Israel or if he was talking to himself, because there is a sort of feeling that he's running out of time and goodwill within the Democratic Party. That's my sense.
I am absolutely fascinated how this ends, and that every other event we've had in the Eastern Mediterranean has been between two identifiable parties. Where's the other side in this debate? I don't see it. And we haven't even talked in days about the northern border of Israel and the threats there.
And then need to get to Ukraine as well, Tom.
Well,
and a split in Washington over another war.
Well, the two wars are front and center here, but he's got another war, which is while you were out, John, the polls were pretty ugly. I mean, it's been one poll, two polls, three polls. He's got a war at home politically. His domestic, it's just not happening. Bidenomics is not working with the people.
Oh, it's not resonating at all, Tom. Had a decent payrolls report on Friday. At the surface, at the headline level, a decent payrolls report. What continues to confuse me, you get those kind of payrolls reports, you think back to the previous administration, there would have been a big ceremony, a big news conference about it, Lisa. You would have seen the likes of Larry Kudlow on every single business network talking about it.
Yes.
And what do you get from this administration? You barely hear from Lael Brainerd on the economy.
She's been invisible. No, stop. She's been invisible.
Absolutely invisible. Where are they talking about these numbers? They're not at all.
Where's the chest thumping that can actually appeal to a broader swath of Americans? They're trying, but it isn't the same kind of, it's the best America you've ever seen, which is essentially what people seem to respond to.
There's some really talented people in that administration that you just do not hear from, which is just absolutely bizarre. On the economy in just a moment, and on markets too, Emily Roland of John Hancock Investment Management in the next hour on Bloomberg TV. Your equity market, just about positive.
Wednesday, the Fed decides.
We're talking rates. We're talking inflation.
Without a recession. That's the good stuff.
Will officials pause as expected?
We're heading into the end of the year. We're in a soft landing right now.
Will they put rate cuts on the table for 2024?
It remains to be seen. The data will dictate that.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Everything was hedged.
They're going to have a good reason to do whatever.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg.
We are thankful for these, our warriors, and of course, USA partners and European partners. We will continue to do this and to make our cities more secure. It's very important that also we had good dialogue, and we are thankful to IMF that you will support us financially. It's very important during this challenging period.
Difficult moment for that man and his country. That was the Ukraine President Volodymyr Zelensky making the rounds in Washington yesterday, meeting with Kristalina Georgieva of the IMF and US Defense Secretary Lloyd Austin ahead of today's meeting with President Biden at the White House. More coverage on that in just a moment. Let's kick off with a price action on the S&P 500, just about positive on the S&P, going into US CPI a little bit later this morning. That data just around the corner. Then on to the Federal Reserve, Chairman Powell at a news conference tomorrow, and then on to retail sales after that. Futures going absolutely nowhere. Yields coming in just a touch. We're down 4 basis points, 418.91, and the Euro, Tom, just in and around 108 here at 107.98.
Front and center, the wars of December in the Eastern Mediterranean and the war of Ukraine. John and Lisa want to dive into that, but I've got to get up to speed on one of the key stories of the morning to inflame the Beltway of Washington. Terry Haynes joins now, founder Pangea Policy. Terry, we want to get to what we saw from Mr. Zelensky yesterday, but I have to ask about the Alan Nakashima, Joseph Menn article in the Washington Post showing that Chinese espionage in America is far more tangible than we were led to believe, including in Hawaii and the Pacific Fleet. This is red meat for Republicans and for Democrats. How will your Washington respond?
Well, you're absolutely right, Tom, that it will be the talk of Washington today. And at the same time, anybody in the foreign policy community, already knows a lot of this, frankly. The foreign policy community, nobody expected China to stand down. In fact, if you read and listen to what the Chinese say, they continue to say and believe they feel threatened by United States activity in the Indo-Pacific and elsewhere. And they're going to do everything they can to make sure that they have the best idea of what's going on inside this country. Frankly, we're a lot easier to penetrate than they are. So, it shouldn't surprise anybody that they're doubling down.
To shift gears to Ukraine, Punchbowl put this out, that Volodymyr Zelensky's visit to Washington, D.C. is largely futile. Do you agree?
No, I don't agree at all. I don't agree that it's. I also don't agree that it's any kind of game changer. One of the things Punchbowl says is that he's likely to find a difficult environment. Well, he's actually not a decision maker in this process. But what we have here is a situation where I think ultimately this gets done. I'm at about 60-40 that it does by the end of the calendar year. But it's going to have to happen if and when Biden and Democrats get serious about border. I've been preaching to people for a month that nothing happens on these aid packages without serious movement to improve border security. And now we're actually getting down to the situation where that needs to happen. Zelensky's plea will help, but until Biden and it can marshal enough Democrats to make some serious incursions and inroads on border security policy, it's not going to.
Terry, this is actually counter consensus, and I want to dig a little bit further because a lot of people think it's not going to get done. What could a feasible border policy look like the Democrats could sign off on and the Republicans would pass?
Well, there's going to have to be an awful lot of improvements. The Democrats say that H.R. 2 is not, which is the Republican wish list legislation that was put in at the beginning of the year. H.R. 2 is not on the table for them. That means pretty much everything else is on the table, from catch and release policy to more physical and electronic security, right across the board. And they're going to have to engage on a lot of that stuff. Now, Biden importantly ultimately, I think, really made a U-turn here by saying that the border situation is broken. That is directly in contrast with what his own vice president, his own Homeland Security Secretary, and others have said. Other senior Democrats, including number 2 Durbin in the Senate, most recently have said that. But he's going to have to turn the ship around pretty quickly. That said, this end of the year deadline, I think, is an artificial deadline that Biden himself put up. They've got a few weeks to do this if they actually put their shoulders to the wheel and do it.
Terry, I thought the last time you were on with us, and thank you for joining so often, you were stunning on disaffected Republicans. With the polling of the present president, what's the path or likelihood or probability of a Republican president, a Republican Senate, and a Republican House, even if so many of the GOP are disaffected?
I think that that scenario, kind of the Republican clean sweep, is a very low percentage shot. I'd give that probably 15-20% today. Trailing risk, but not much more. The reason doesn't have much to do with national Republican sentiment. It has everything to do with the small nature of the Republican majority in the House. There's only a few seats need to flip. And number one. Number two, a lot of those are in blue states, New York, for example. And Democrats are going to throw a lot of firepower at those. So, the likelihood that a few of those seats flip and the House becomes nominally Democratic, I think is pretty good. The map is much better for Republicans in the Senate, so there's a greater likelihood that it goes Republican there. And in the presidential, one of the things that I said earlier last week was I think the Republican Party at least temporarily splits if there's a Trump candidacy, but at the same time, there's so many disaffected Democrats that both of those circumstances together make the likelihood of a consequential third party candidacy much greater than it normally would be.
Terry, let's finish on the economy if we can. Inflation is coming down based on incoming information. Jobs growth is still okay. Terry, this administration still wants to talk about Bidenomics, but Bidenomics seems to mean something very different to the electorate. Why is this not resonating?
It's not resonating because the case isn't being made, first of all. I find that increasingly in politics these days is that, people talk to themselves, but not to anybody else. There's very little convincing going on from anybody. Secondly, to your conversation before the break, there's very little energy in the executive here. The White House decided to glom onto Bidenomics as a message, which was already out there, as a message that they perhaps could make inroads with, and that's not working at all. And that narrative now is so entrenched after a year plus that it's going to be very, very difficult to make that go away. Bush 41 found this in early 1992 when Clinton was going on about it's the economy, stupid. We were already coming out of a recession, so the Bush people fooled themselves into thinking, well, this is all transitory. This will go away. We'll be in much better shape for the general election. And boy, did that not happen. So this is an intransigent narrative at this point.
Got to fix it. Terry, thank you, sir. Terry Haynes there of Pangea Policy. It's kind of a head scratcher, TK. You've got these very sharp, credible people in the White House. I'm thinking of Jared Bernstein, an old friend of this program. TK, I'm thinking of Lael Brainerd, formerly of the Fed and now of the National Economic Council. Why aren't we hearing from them every single week?
The answer is we don't know. And with Ron Klain exiting, I think the smoothness of the machinery maybe is not what it was 2 years ago. But what can be said, I think, without question, is this is all going to get written about 4 years, 6 years, 8 years out.
The problem is, what is the message? Look at oil prices. They're near the lowest ever. And partly the reason why is because we're pumping record oil. Do they go there?
No, they can't because it's against their script.
But to my point is, there are a lot of things that should make people feel a lot better.
Sure.
And you are seeing that in pockets. But you can't really come up with a cohesive message around that.
I absolutely love the crude production story. Republicans get to go around saying we're not pumping enough crude, even though it's at a record, and no one in the White House wants to correct them. Precisely for the point that you're making.
I'm going to sound like Scoop Jackson.
Bizarre.
Scoop Jackson 50 years ago. Is there script to be positive? That's a key thing.
From New York City this morning, good morning. What a big 48 hours coming up. CPI this morning, then on to the Federal Reserve tomorrow. Retail sales after that. Your equity market looks like this on the S&P 500. Totally unchanged after 2 days of gains on the NASDAQ. We're positive by just 0.1%. Tech struggled yesterday. Tom, tech struggled and the S&P still did okay. Breadth improving.
Distinction, I don't have the math in front of me, but SPX went up, breadth improving, and all of the Magnificent Seven dipped. It's not that they cratered, they plunged, whatever, but you're right. There was a real statistical nuance yesterday to identify Beth. Uri and Timmer at Fidelity leading the way on the chart showing the story.
Let's lead the way in the bond market. 2-year, 10-year, 30-year. Bramo shaping up as follows. The 2-year down over the last couple of days. We're down another 2 basis points on a 2-year this morning, 468.25.
And how much is this entirely responsible for the increase in breadth that we've seen in equity markets? I just want to point to that. The KBW index since October 20th, which is one of the tops in the benchmark yields, up 22% since then. Just to give you a sense of that, there was an auction. It didn't go that well, but it wasn't terrible. And then another one similar. So then people are basically saying this is stability and we can come in and buy here.
Dumb question. Do you know when there's an auction who's buying?
That's something that people examine, and we can ask our next guest because I'm sure that he has a lot of views on that. But there is this question around, is it international or increasingly domestic, particularly older people who can actually get income?
See how she looks at me when she says
I actually looked specifically at the camera to
avoid
today. Just this comment.
It's just absolutely, she's just vicious.
Are you two done? What did I miss yesterday?
I'm taking off the rest of the year.
Fireworks, are you?
It was a domestic.
What's that? Good to be back. I think I've said that twice now. Not sure I meant it either time. Let's get to the foreign exchange market. The euro looks like this. The euro against the dollar, 107.98, positive here by 0.3%. Easy to forget, Lisa, there's an ECB meeting a little bit later this week.
Thursday, and people are looking for basically nothing. And yet this is, to me, the big consensus bet that sort of is under the covers a little bit, that the ECB is going to cut rates before what we see from the Fed. So is the Fed going to set the script, say something, and then the ECB will say, okay, we can do it now?
And then we've got parity calls over at BNY.
Exactly.
Morgan Stanley saying maybe we can get there as well next year, looking for that stronger dollar. Let's get you the top stories under surveillance this morning. US inflation data 2 hours away. The median estimate in our survey calling for a headline reading of 3.1%, down slightly from last month. Core inflation expected to rise 0.3%. Wall Street's biggest banks in consensus on that figure. TK, a year ago, November 2022, CPI had a 7 handle. We've turned that around. I know the base effects kick in and all of that good stuff, but that's a very different story 12 months later.
I mentioned a couple days ago, Furman up at Harvard teaching Act 10, and you can take I take a 3-month annualized. I take 3 months data and spread it out 12 months. But he has a wonderful matrix of summing up all sorts of annualized studies into a single message, if you will, and it still says disinflation.
Goods disinflation, even goods deflation.
David Rosenberg said yesterday, service sector disinflation is starting to click in.
Well, the good side of things sets up the next story. Toy manufacturer Hasbro cutting close to 20% of its staff, citing slumping holiday sales. Lisa, analysts expecting the company's sales to decline 19% this quarter. Here's the quote from the CEO. Market headwinds have proven to be stronger and more persistent than planned.
I think your point is well taken, which is how much is this really the pandemic hangover and a normalization? I also think that especially if people can't move because of mortgage rates, the idea of limited space is leading to a lack of desire for clutter. I'm just saying personally, I've heard this also from other people. You don't want more stuff if you don't have more space. It's the bottom line. I'm sorry, this is personal, but it also is what I hear. It's also what I hear from others. Again, though, I wonder how much is the transformation to the computerization of our children versus the tangible.
The kids aren't getting toys this Christmas.
They're just getting apps.
Message received.
Apple
okay.
Cash.
Massive reality check, not for Casa Bramo, but for Ford and the EV push of this administration. Halving its production goals for its electric F-150 truck, citing slowing demand for battery-powered vehicles. The company scaling back spending on electric vehicles by $12 billion and downsizing its battery factory in Michigan. Ford saying, quote, we will continue to match production to consumer demand. And right now, Tom, based on those production figures, that demand ain't there.
Yeah, I'm glad you bring it up. To me, it's a ginormous mystery of where will we be in 1 year. Ford's trading with a PE, and I get it that the fundamental analysis of autos, it's 6. Like 5 or 6, like an unimaginable number. The stock chart ain't so pretty. And this is a huge issue. What we saw was cost cutting a couple days ago. Your conversation with Mary Barra of GM. I mean, the basic idea they're rationalizing out everybody wants to do this, but
it's speed versus direction. Directionally, if this is the way the world's going, got it. Okay. This is the way policymakers want to push us. Absolutely. Got it. Okay. But speed, Bramo, are we moving too quickly based on the lack of demand that these big auto manufacturers are finding out about, which is Ford, GM, and all the rest?
And John Lawler of Ford, the CFO, did say that they're actually pushing out their target and lowering their expected adoption. But how much of this is really due to the infrastructure, the charging networks that people need to have developed before they go out and invest in a truck like this?
Into the economic data we go, and we'll have many voices for you, but this is absolutely definitive, and it's time for Global Wall Street to stop and listen to Anthony Crescenzi, to say he's market strategist, portfolio manager at a West Coast shop called PIMCO, barely describes his authority on short-term rates and how they redound to the Fed out the yield curve. Tony, thank you so much for
Tom.
joining
Great
Surveillance. I'm going to cut to the chase. The real yield, the inflation-adjusted yield, negative, way out above 2. It's come back. It's 2%. Where is that yield, the inflation-adjusted yield, in 1 year?
It's difficult to say, but it's likely to stay lofty, but it'll probably come down. And the central argument for that is the Federal Reserve. One should have confidence in the institution, that is, in its ability to foster price stability. It may be difficult to get to 2%, which is its inflation target. We see today inflation over 4%, and it's been there for some time, and it peaked in the 6s, hit 9% for the overall level. But the Federal Reserve has a sufficient arsenal to bring the inflation rate down, and so one has to believe in its ability. Now, fostering price stability is different than getting to that 2.0 in the sense that the different definitions of price stability. Some could say it's 2.0%, but Alan Greenspan, former Fed chair way back, would say that price stability is achieved when price levels cease to be a factor in decision-making for households and businesses. That's likely to be the case before long. We see the inflation rate continuing to move down in 2024.
But the key thing here to the real economy is the new positive interest rate is tangible sector by sector through the Standard & Poor's 500. Are we going to, Yardeni's calling this an equity bull market, a roaring 2020s. Is this a real economy that can withstand this new interest rate regime, this post-pandemic regime?
Well, yields today are attractive relative to history. Today's yields doubled last decade's average. It's higher than the 20, 30, and almost near the 40-year average period that includes higher interest rates. It's attractive relative to expected inflation and expected volatility. The economy can handle it to some extent, but it can't in one major way. And this you see playing out in government bond markets. Think the UK in 2022. Prime Minister Truss suggested lowering taxes without giving a solution for paying for the increased indebtedness. The bond market pushed back violently. The yield on the 10-year gilt, as it's called, the government bond there, rose 150 basis points rapidly. You could say the bond market vigilantes came out and disciplined the fiscal authorities, and Prime Minister Truss was ousted. I like to call it, because I wrote a book about this idea, a Keynesian endpoint. Keynesian endpoint where we reach practical limits to the use of debt.
No, that's where the Dodgers buy Ohtani for more money than God. That's a Keynesian endpoint.
So the world is seeing that. So the high levels of debt do make it more challenging for nations to have high service costs. And here's one idea. What I call the read my lips moment ahead for perhaps the United States and other nations. Read my lips for George Bush, 1988, in a speech written by Peggy Noonan, Ronald Reagan's famous speechwriter. At the convention, he said, read my lips, no new taxes. He had to break the pledge 2 years later because the interest on the debt rose to 3.2% of GDP, which was a record that still stands. Well, in a few years, we'll breach that. Politicians like Bill Clinton and his Treasury Secretary Robert Rubin solved the problem. We eventually had budget surpluses, but Washington doesn't seem to be the kind of place these days for those types of solutions.
As an investor, Russ Kostridge said that he's liking credit as a possible greater component of the 60-40 or maybe 65-35, that credit is offering sometimes a more attractive proposition, both from the fundamentals as well as the yields, the government debt. Do you agree?
In general, I mean, historically, if you look back, it's better to have some overweight to credit than not. We'd suggest an investor needn't reach very far for good yields in terms of risk-adjusted yields. because yields are higher. We do think that this is total return time. This was a year for clipping coupons in, let's say, the Bloomberg aggregate, the high-quality bonds, but next year is more likely to be total return time. What we've seen historically since 1978, core bonds, those with duration, average maturities, call it 5 to 7 years, have beat cash 90% of the time by an average of almost 300 basis points per year on a 3-year rolling basis, which is to say, looking at the story 3 years from now back and seeing how returns were, it's likely that having some duration rather than being in cash will win. So core will be king, its total return time, and that includes high-quality investment-grade bonds because, of course, looking at the Bloomberg aggregate, it's about a quarter of the universe.
How do you pair this idea that you're going to get great total return from corporate debt as well as government debt next year with the bond vigilante story and an unsustainable debt profile of the United States?
Well, in 2024, the bond market, fixed income investors understand not much will get done in Washington. But it's in 2025 that the bond market will be looking closely at what's proposed. You could imagine a situation where a president decides perhaps to propose increasing indebtedness. You would expect perhaps the bond market to push back in that case, and there could be some volatility. We would suggest, though, that the bond investor today shouldn't worry about that. For one, it's in 2025. And secondly, because the bond market is in control. So James Carville's idea of being reincarnated, Bill Clinton's former campaign manager, as a bond investor, because you can scare everyone, is something to be thinking about because the bond market will discipline the fiscal authority.
Enough fixed income. Should we do Otani? The real interesting stuff. The fact that he's going to get paid $2 million per season and defer $680 million until 10 years' time. Wall Street Journal's got an amazing story on this. So 680 is going to pay out between 2034 and 2043. So work out what this means for taxes. I'll read this quote from the Wall Street Journal story for you all at home. During the last 10 years, or rather during the first 10 years, he will be subject to state income taxes on his annual $2 million salary in California and wherever the Dodgers play. But by the time he starts receiving the $68 million payments, he may be able to avoid state income taxes by living someplace like Florida without an income tax or by moving back to Japan.
680, you misspoke.
That's the story. What did I say?
68. It's move the decimal.
68 a season.
Yeah.
68 a season.
Yeah.
So it's going to be 68, Tom. 70 a season. $2 million is going to be paid up front. 68 per season deferred. Over 10 years, $680 million.
Yeah.
That's how the math is going to work. Nuts.
Or does he even move out of the country? I mean, there's other, not shenanigans. That's not accurate to say that, but this is tax planning, isn't it? I would suggest.
Big time. And then the Dodgers get to spend more money on players, right? In between.
Yeah,
what do other teams think about this?
It really helps the cash. Well, I think I said, and Damian Sassower, Bloomberg Business of Sports, was adamant yesterday. This is game changing across all sports. What's it do to Formula One? Who's the guy that won Formula One this year for Christian Horner?
Max Verstappen.
Max Verstappen. Yeah. What's he worth after this discussion?
A lot of these guys already live in Monaco, so.
Well, yeah. Well, now they're going to own Monaco.
They've Reggie Jackson
figured some of it out. These numbers.
You got Dodgers tickets out there? I mean, do you got Dodgers or Padres
tickets? No, I'm
tickets?
a New York Yankee fan all the way.
Oh, there we go. Oh, they have Juan Soto.
They do.
This is hello, Boston. Come in, Boston, please. Come in.
Mookie Betts, where's he, TK?
Thank you.
Yeah. Over the Dodgers.
You want to chime in here, Lisa, on 1986? You want to just pick it up?
Go Mets.
Yeah.
Tony, good to see you. Tony Presenti of PIMCO. Thank you, sir. Coming up a little bit later on the economy on the Federal Reserve on CPI data later this morning, Lindsay Piegza of Stifel. Your equity market on the S&P just about unchanged on the S&P 500. In the bond market, yields look like this on a 10-year, down 4 basis points, still sub 420 at 419.49 from New York City. This is Bloomberg.
Yes, it's end of cycle, and that means one of two things. It means a hard landing, or it means that we're going to have some new exogenous shock or driver for positive growth. Okay, the kind of status quo of decelerating growth, falling inflation typically is not good for equity. So the no landing scenario was always kind of a fantasy. Right now, the first half of the year probably feels more like a hard landing still, and then maybe in the second half we can get a broadening out.
That was Mike Wilson of Morgan Stanley on this equity market and where this equity market is going next year. This is where it is right now. Your stock market looks like this. On the equity market, the S&P 500 totally unchanged, going nowhere. Yields coming in 3 or 4 basis points on a 10-year, 4.1949. Dollar a little weaker, euro stronger. In fact, the dollar weaker against most things in G10 through much of this morning. 107.97 on that currency pair, positive by 0.3%. Busy week ahead. Counting you down to CPI just out in about 2 hours' time, followed by the Fed rate decision tomorrow and the ECB and BOE decisions on Thursday. Lindsay Piegza of Stifel weighing in on the Fed, writing this, TK. The market is convinced the central bank is done with rate hikes, with the first rate cut potentially as early as March. However, with the recent head fakes in inflation, at least some on the Fed may not be convinced inflation is yet in a sustainable, orderly and timely downward trajectory back to 2%.
Timely is a key idea there. Maybe the inertial force of disinflation back to wherever anybody chooses that we should head. Very sophisticated in this analysis is Lindsay Piegza joins us this morning. Lindsay, thank you so much. And on this moment of inflation, if you will, what I find fascinating is getting the last mile. Let's say we're at 3.8. Getting to 2.8 is a whole different story than what we've seen the last months.
Absolutely. The last 100, 200 basis points is always the most difficult. And to your point, it's not just the nominal level of inflation, but it's the underlying momentum of disinflation that the market is really looking for. We want to be convinced that we're on that sustainable downward trajectory. And if we look at the third quarter, with that recent backup and then sideways movement, that's not convincing that we are on this sustainable, timely trajectory back to 2%. So my concern is the longer the Fed remains on the sideline and slow plays inflation, the bigger the risk the Fed will have to come back in and take further action and maybe slow the economy more than they would have otherwise needed to if they'd simply dealt with inflation the first time around.
Let's get into it. Where are the improvements coming from over the last 12 months? Where have they come from?
We've seen some widespread improvements in terms of inflation. It's moved over from the goods side into the service sector, widespread. But again, a lot of that downward momentum, a welcomed gauge as we move into the key holiday spending season, is from energy prices. And so when we talk about the reversal there, that's probably not a long-term sustainable trend. We could see bounce back up in the first quarter, again, forcing the Fed's hand maybe to take further policy action.
One thing we've asked regarding the Fed is how much of the improvement in inflation is down to the Fed Reserve and how much of that is just a natural rebalancing of the economy. It's come from the supply side. I know it's tremendously difficult to gauge, but if we're going to talk about the prospect of higher interest rates from here, we also have to understand what higher interest rates have done so far over the last 12 months. What have they done?
I think the Fed can take responsibility for the improvement that we've seen on the demand side. Certainly not the supply side, not the good side of things, as you talk about the recalibration in the aftermath of reopening the global economy. But on the demand side, we have seen the consumer pull back. Momentum has slowed from double-digit growth down to 8, down to 6. We're now at low single digits. Consumers are still spending, but at a remarkably lower pace. So that loss of momentum, I think we can attribute to the Fed. But clearly they haven't done enough to see below-trend job growth, to see below-trend spending activity, and certainly not enough to get that prolonged period of below-trend top-line activity to ensure a return back to stable prices.
Just wait. That's Mike Wilson's message. And what we hear from certain executives like that of Hasbro seems to be something similar. They are seeing a deceleration in consumer appetite. We heard the same from Walmart. How do you pair that idea with some of the recovery that you're seeing in services and other areas that you think could fuel inflation again next year?
Well, this is the big concern. Do we wait on the sideline and hope that inflation slows, or do we take further action to ensure that prices slow? And from my point of view, I don't think the risk is that the Fed tightens too much, but that the Fed doesn't tighten enough and allows inflation to become further entrenched. And this is really the mistake that they made on the front end. If we go back to the initial start of the tightening cycle, they held on to that transitory language too long. They allowed inflation to become too ingrained, and we're now trying to deal with, particularly on the wage side, these ingrained levels of price pressures that are complicating this process to get us back to 2% inflation.
What should they look for to be confident that they can start easing?
Well, one, a downward sustainable trend. This back and forth sideways movement doesn't instill confidence. But second, we need to see broad-based improvement in some of the most sticky components, particularly wages. And last Friday's employment report didn't give us that confidence. We're still talking about 4% annual wage growth. We have come down from peak levels, but that's not enough to suggest that we've done enough in terms of tightening.
On behalf of 331.9 million Americans, can you explain the USDA, the Department of Agriculture, tells us in October we had 3.3% food inflation. No one is experiencing that. Food inflation is just shocking at the grocery store, at restaurants. John had a $68 steak the other night, whatever. But the answer is the reality. This is what I get 24/7. The reality of inflation is totally different than the verbiage of people like you. What's the divide here?
Well, I think a lot of the differential is the wholesale prices versus what we're experiencing as the end consumer. Because we're not going down, we're not buying the fish at the market, we're buying the fish at the restaurant or at the grocery store. And that is the pipeline of price increase that the consumer is feeling. And so 3% food inflation, no, we're not feeling that. We're feeling more like 15, 20% food inflation. But from the Fed's perspective, again, they're looking at the broad-based components of inflation that regardless of where in the pipeline they want to look, we're still above 2%. We haven't gotten back to price stability.
Right.
There's more work to be done despite the market's consistent overreaction and constant calling for rate cuts. Fed officials are still talking about reaching that sufficiently restrictive level.
The Bloomberg Financial Conditions Index, the Goldman Sachs Index, somewhat the same, all show accommodative structures right now. Part of that is a buoyant stock market as well. Into this meeting and with this report in 90 minutes, are we restrictive or accommodative now?
Well, that's the question. Are we really as restrictive as the Fed thinks? Have we reached that sufficiently restrictive level? And some of these indices say, no, we have not done enough. And when you look at growth... So
are you talking about a rate increase?
I think it's not out of the realm of possibilities that we see a further rate increase. If we see stability in inflation, and then as we move the calendar page into 2024, we see a little bit of an uptick, I think that could force the Fed's hand to take one final rate increase to convince the market that 3 is not the new 2. Orange is not the new black. We have to get back to 2% inflation, and they will not tolerate an above-trend level.
Why is 2 so important?
Because that's the balancing level of inflation that allows the economy to continue to accelerate without moving into a hyperinflation scenario, but also keeps the economy afloat and avoiding the deflationary scenario. So it's a delicate balance that the Fed is trying to walk. And we don't have to pinpoint exactly 2% inflation. Remember, it's the longer-term average. So as we fail to reach 2% for the better part of a decade going into the pandemic, arguably the Fed may be willing to tolerate slightly higher inflation. But again, it's about that downward trajectory of momentum that we haven't established.
I just wonder if we become too focused, Tom, too myopically focused on this 100 basis points. I remember from the other side of it, at 1, searching 2, and all the effort that global central banks went to try and get inflation up, Tom, 100 basis points, whether the effort required to get us down from 3 to 2 would be equally damaging in a different way.
There's been a lot of study on this, starting with Blanchard and Stiglitz at the IMF off of 07, 08, and of course it's been rekindled 3 or 4 times forward. Olivia Blanchard's book last summer addresses directly linked into fiscal policy. And the answer here is, how much work does it take? And the answer is no one knows. And the other answer is it's got to have a price. It's got to have a cost at some point. To me, Lindsay's job is to aggregate everything that's out there. And my answer is we're a disaggregated America. We've got a haves, technologically laden. They don't care about inflation. They're off skiing somewhere.
Who's that?
Pine Tree, Vermont.
Federal Reserve officials.
They're off at Pine Tree, Vermont, wherever. The rest of America's flat on their back.
All right. I'm not going to say
Oh,
anything.
right. I thought you had something to say.
No.
Okay.
I'm just sort of, we can move on now.
Okay. You want to move on now?
You've
been going skiing. Is this about you?
I went skiing this weekend. Okay. Yes, it was the first skiing of the weekend. That's what that was about.
Why am I missing the inside jokes this morning?
Because you weren't here yesterday. See what you
missed? You missed us singing White Christmas.
Was he trying to bully you? We're going skiing.
Look, it was great. I enjoyed it. I'm feeding into the, consumption of America.
Good
keep
for you.
This economy strong.
Was that America? Nice. Lindsay, thank you. That was a clinic.
Thank
you. It really was. Thank you very much. Lindsay Pieksa there of Stifel. I'm out of the loop this morning. Equity futures on the S&P 500 totally unchanged. Emily Roland of John Hancock Investment Management coming up shortly. US CPI 94 minutes away.
The equity markets got very excited at the end of September and the beginning of October, thinking, you know what, the Fed is done.
The Fed is engineering an economic slowdown. An economic slowdown impacts earnings.
We definitely are seeing higher interest rates bite in a more meaningful way.
Growth is likely to be a lot worse than it has been over this past year.
I don't think even in a slower growth environment from an economic perspective, we're likely to see another big hit to earnings.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market on the S&P totally unchanged. TK, we are 90 minutes away from inflation data in America.
Yeah, to me, the headline is the equities won't go down. They did not go down yesterday, and I'm going to link in the prosperity of the markets, the real economy, into this inflation report in 90 minutes. I mean, this is what people want to see, and to go from inflation to the Fed, the ECB you mentioned earlier,
Sure.
Bank of Japan, December 19th. You know what? It's a set of good news into year end.
You just wonder, TK, what's more important this week? I'm sure you guys talked about it yesterday. Lisa, the data, CPI, retail sales, or just the tone of the news conference from Chairman Powell at 2:30 Eastern tomorrow.
What should matter more, I think, is the data. I'm going to just make a moral statement there. What will matter more potentially could be how asymmetric the potential risks are to over-tighten or under-tighten, and whether they are open to cutting rates in March as the market is expecting.
To your point of the data, the key observation I've had in the last 10 days is Gina Martin-Adams of Bloomberg Intelligence Equities, where she said everyone's focused on monetary dynamics, you know, the LM curve, if you will, and the IS curve, the real economy is where we are. Judd, you mentioned this when we sat down. You walked in the door at 5:55, and I got you in the first minute, and you said productivity matters. And the answer is productivity matters.
That's part of the Ed Yardeni call for 6,000 on the S&P 500 by the end of 2025. I think we've got to ask going into tomorrow, are we seeing signs of a credible slowdown in this economy? Morgan Stanley thinks we are. Other people might be pushing back. I can tell you one company that is. It's Hasbro. Lisa, cutting 20%, almost 20% of the staff in the holiday season, 2 weeks before Christmas.
It's just kind of brutal. I mean, just emotionally, for people to see that the toy maker is not going to do well speaks volumes about what's going to be under the tree. What I'm thinking of is it just isolated to the goods sector. Ernst & Young coming out in the Wall Street Journal this morning, laying off dozens of partners, in part because attrition wasn't as great as they expected. In other words, people aren't leaving. They beefed up during the pandemic, and people aren't leaving. The quits rate is really coming down. This is important. There are signs that people aren't as liberal about their opportunities as they were during the pandemic.
They've at 39,706. The original Slinky walking spring toy, metal Slinky. Did you have one of these, John, as a kid? Went
Yeah, the
down
thing that goes
Slinky
down the
thing?
stairs.
Are you going to buy it from Amazon, or are you going to buy it from Hasbro? That, to me, is the point.
You'd probably go to Amazon for that.
Amazon. I think they affect all
How
of
much
this
of it, Tom, is that
analysis.
over at Hasbro? How much of it is just the post-pandemic normalization? All that goods demand has just shifted. And to Lisa's point, a lot of people these days, they want the software, not the hardware, from places like this.
Yeah, I think the app thing is tangible. I don't know how to gauge it with a 8-year-old or a 10-year-old or a twerpy 16-year-old. I mean, I wouldn't know what the 16-year-olds don't need toys. They need
money,
tuition.
But
money.
So I will just say that
Money. Can you just give us
can
money?
buy Hasbro on Amazon. Just want to
Can you
throw that
sell
out
it to me?
Yeah.
Can you sell Christmas to me?
The entire show is going to be. Let's just move on.
Did you two have a fight yesterday?
We did. We had a
What
massive
happened?
domestic.
What did I miss?
No, it was great.
Thank God our agent got in the middle of it.
You noticed how I asked Lisa that question, not you.
Yeah,
She'd never
thank
tell
you.
me the truth. Here are the scores on the S&P 500, 90 minutes away from that inflation data. Equities going nowhere. Yield to lower again by 4 basis points on a 10-year. It's a break of 420 at 419.10. In the FX market, the euro a little stronger, dollar weaker here across G10. Lisa, that currency pair 107.98.
The main event coming up in 90 minutes, 8:30 a.m. We do get the U.S. November CPI. I'm watching core CPI. I think that's going to be the most interesting. It is expected to stay flat at 4%, way above the 3.1% expected for the overall headline CPI. At 1 p.m., this is probably the issue between Tom and me this morning. I really think that the auctions are important, and he keeps denigrating them and saying that they're not important, and it really cuts deep into me. Today, Tom, there's a $21 billion 30-year bond auction, and I want to see whether it goes well, because the last time it didn't go well, and it actually roiled the whole market.
She's going to burst into tears. Pick it up, Jen.
Okay, also, Ukrainian President Volodymyr Zelensky is in Washington, D.C., meeting with President Biden. We are expected to hear some sort of press conference, and I'm curious to see whether he actually can do anything, because there is a feeling that this is futile based on some of the disagreement in Congress. And we heard from Terry Haynes, he doesn't see this as an exercise in futility. He does think that there's a possibility to get a deal across, but he was placing the emphasis on the Democrats coming to terms with something with border control. Honestly, that's very fuzzy to me. I don't have a full understanding of what's at stake and where the push-pull really is.
From where we were 8 months ago or 1 year ago. Wow, what a change.
Big change. AMH coming up in about 10 minutes from Washington. Look out for that conversation with our Chief Washington correspondent, Anne-Marie. With us now, Emily Roland, Co-Chief Investment Strategist at John Hancock Investment Management. Emily, always wonderful to catch up with you. We're seeing some signs this rally is broadening out. The breadth is improving. Is it the real deal this time going into next year?
Yeah, John, right now it's a Fed pivot party and we're all invited. So markets have been celebrating this idea that there's disinflation in the pipeline. Of course, we get CPI later on this morning, but you remember that October CPI report was absolutely pivotal for the markets. It was amazing to watch. It missed by 0.1%. And we saw this massive rally in bonds. We saw the dollar weaken, and then the party kept going with risk assets rallying. We've got high yield bond spreads well below 4%. We've got Bitcoin rallying, well, until yesterday, and other higher risk parts of the market, meme stocks back in the headlines. So investors are really celebrating this idea of disinflation. And of course, in November, we got the best month since the 1990s for a balanced portfolio. We've pulled forward a lot of excitement, I think, about disinflation here. So I would expect the market reaction to be a bit more muted, even if we continue to see inflationary pressures subside into next year. And I think, if you look at Matt Miskin and I just penned our 2024 outlook, and we called it stocks are stories and bonds are math. And the idea, and we can talk about this, is that there's been a lot of value unlocked on the fixed income side, where there's actually been less value created on the equity side as a result of multiple expansion this year.
Emily, what does cash do next year? If I believe in productivity, if I believe in a post-pandemic America, do I regret being in cash in the first quarter?
Yeah, it's a great question. Right now, there's about $6 trillion sitting in cash nearly. It is remarkable to see this swell of money that's just sitting there in money market accounts and the equivalent. And our view is that you want to be fully invested into next year. Yes, we may see some challenges on the equity front, again, as valuations are very fulsome right now. But we think bonds can play a bigger role in portfolios in the next year. We came into the year at about 4.8% on the 10-year. We went to 5. We're back down to 4.2, but there's been, 3.8 coming into the year. There's been a lot of value unlocked there. We're looking at income on high-quality bonds of 5 to 6% as being really, really attractive. And then we think that equities can continue to chug along here. So I think cash, unusually, after the last year or so, it might actually be the biggest drag to portfolios into next year.
Which goes to your point that it's a Fed pivot party and we're all invited. What do we have to see today in the CPI report to give legs to that kind of narrative?
Yeah, I think you certainly don't want to see it surprising on the upside here. I think a lot is sort of, the narrative really has been that you can see, of course, headline CPI coming down here a little bit as gas prices have come down. You might see a modest move higher here in core CPI, areas like hotels, used car prices. There may be a little bit of noise in the data due to the UAW strikes being over. So, that may have limited production on the car, on the auto front. So a little bit of noise there, but I think, markets are really expecting a continued moderation. They're pricing in, 4 or 5 Fed rate cuts next year, which might be a little bit aggressive, especially going into the Fed meeting on Wednesday.
So where do you lead in and where do you push back?
Yeah, so from a markets perspective, again, right now we're leaning into, owning areas like mortgage-backed securities, municipal bonds, investment-grade corporate bonds. Those are really the areas that we think can offer value. We still are finding opportunities in equity markets. Frankly, we were surprised by the multiple expansion this year. You look at the returns in stocks, over 20%, 13% of that just came from PE expansion. And then you get this big re-rating and earnings estimates, which also contributed another 6% to total return. I just think that's going to be hard to come by again into next year, especially since the S&P 500 is now sporting a 19 times forward multiple on top of 12% earnings growth being penciled in. A lot of that, of course, the Magnificent Seven drove the returns this year. You got to be a little bit worried about their ability to do heavy lifting in portfolios next year. We still like it. Higher quality, great balance sheets, lots of cash. We want to own it. We think it makes sense to pay up for it. But we also are looking to diversify into areas like U.S. mid-cap stocks, more defensive equities, in order to balance out that portfolio into next year.
Let's finish on that Fed pivot party. You say everyone's invited. I'm going through the guest list. There's one name missing. Did Chairman Powell RSVP?
Yeah, I think he's going to want to throw a little cold water on the party, or maybe he's the parent that's shooing the children away from the keg when the meeting happens today. You know, I think he's got to push back against easier financial conditions. It was the last Fed meeting that really, again, caused this kind of exuberance across markets. He suggested that the risks are balanced between doing too much and doing too little. I think Powell's got to push back. He's going to come out a little bit hawkish today and try to temper those expectations that the Fed's going to be cutting aggressively in 2024.
The two-day meeting begins today. I don't think there's a keg party going on down in Washington at that particular meeting. Emily, thank you. Emily Roland there of John Hancock Investment Management. Emily, have a wonderful Christmas if we don't talk again before the holiday period. Lisa, how credible is, and this is the question Bank of America's asking, how credible is a hawkish hold tomorrow? This market's just on its own planet, living in its own world, and it doesn't need Chairman Powell endorsement, does it?
It's exactly what I was thinking as Emily was talking about this. She basically is expecting hawkish sort of talk that she will then disregard because it's a pivot party and we're all invited.
That's what's happening.
Which is essentially the entire market's attitude at this point,
Right.
given the fact that maybe there's a credibility gap here.
That was brilliant, what she said there. And this is so important, folks. Let's put this in perspective. And, John, this is what everybody got wrong in January. A year ago, we're going to have multiple compression. It's over.
Because
we're going to
rates are
slip
up.
back under 20.
Yeah.
The whole real economy, real stock market analysis away from the Fed. Price to earnings ratio, price of stocks is compared to earnings. The Standard & Poor's 500, everyone agrees 21.23 is a lofty statistic. You take the reciprocal, we're not going to do that now. Apple, 31.57. That's what Emily Roland nailed.
Fundamentals haven't been great at that company over the last 12 months.
The
Stock
profit
returns,
has been great.
phenomenal.
If you
I'm
look
talking
at it,
iPhone sales
growth.
specifically.
Yeah, growth. It's not a growthy story except for services, but it is for profit.
Amazing gains. If you are just joining us, welcome to the program on the S&P 500. Almost totally unchanged here. Positive 0.01%. Yields are lower by 4 or 5 basis points, 418.53. And for me, this is it, Lisa, going into tomorrow, CPI later on. Ultimately, looking to see how the market responds to Chairman Powell. That's it in the news conference. And let's say we get that hawkish hold. We know what happens if he endorses market pricing. But if we get that hawkish hold again, does this market just continue ignoring him?
Honestly, yes, that's what we just heard from Emily Roland, unless there's some specific details about why they are going to be more hawkish and not necessarily cut rates as soon as March. To me, it just seems like the market's going to disregard that, which is the reason why I'm actually more interested in the actual numbers, the CPI report, the retail sales, what exactly is going on at Hasbro, what exactly is going on at Ernst & Young, how much is the economy cooling beyond what we expected, and are cuts necessarily good for risk assets?
I'm with you on retail sales. Just on the retailers, they're coming into the holiday season, they're guiding us cautiously, and then we see the numbers come out of Black Friday, Cyber Monday, boom, supported by Buy Now, Pay Later. Going to see what they look like when we get the numbers on Thursday morning. CPI just around the corner, retail sales in a couple of days' time. The Federal Reserve is the meat of the sandwich in between. That's 24 hours away.
Did you practice
Thanks,
that?
guys. Just made it up. All right.
Wednesday, the Fed decides.
We're talking rates. We're talking inflation.
Without a recession. That's the good stuff.
Will officials pause as expected?
We're heading into the end of the year. We're in a soft landing right now.
Will they put rate cuts on the table for 2024?
It remains to be seen. The data will dictate that.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Everything was hedged.
They're going to have a good reason to do whatever.
Bloomberg surveillance. The Fed decides. Wednesday on Bloomberg.
I will not endorse prior to the Virginia primary. I'm going to let Virginians choose. And second of all, I firmly believe that Americans, Republicans, independents, and a load of Democrats understand that we can't, as a nation, afford another 4 years of Joe Biden.
That was Governor Glenn Youngkin of Virginia, speaking exclusively with Bloomberg's Anne-Marie down in Washington. We'll catch up with AMH in just a moment. Here's the stage is set as follows. The price action looks like this on the S&P 500. Positive 0.02% on the S&P. We are unchanged. Yields are lower by almost 5 basis points, down to 418.72 on a 10-year. The dollar is weaker. The euro stronger. 108. 108, reclaiming 108. That currency pair is firmer by a third of 1%. The inflation data is about 1 hour and 13 minutes away. Citi's Andrew Holdenhorst publishing just moments ago saying not a nice and neat slowing to 2%. We think this type of inflationary backdrop will make it hard for Fed officials to cut rates until activity data are more clearly weakening, which is why so many of us are looking ahead, not just to CPI this morning, but onto retail sales, TK, on Thursday, 2 days away.
Retail sales to me is a huge deal. And, within all this data, including what we see this morning, is, you mentioned this earlier, John, the service sector dynamics still front and center. There's an assumption of goods deflation, outright deflation, like outright deflation with pork in China. This is not about pork. It's not about goods. It's about service sector. Is it quiescent?
We've seen the rebalancing in goods. And you're right, Tom. That's the next step. We're going to see it elsewhere. That was perfect, TK.
Okay, that's where we are this morning. But I look here in 10 minutes or so, and it's different off of the jobs report on Friday. Is it about the real economy and employment, or is it just rates, Fed talk?
Wall Street versus Main Street.
Yeah.
Wall Street's looking at the month-over-month figure, working out whether the Federal Reserve is going to surgically reduce interest rates or go all at once. Main Street's focused, Tom, as you know, on the sticker shock of the cumulative inflation over the last 3 years. That's the difference.
The cumulative inflation is tangible, particularly in Virginia. Anne-Marie Horton, in conversation with the governor of Virginia, our Bloomberg Washington correspondent last night. I believe the election results weren't so lovely for the governor of Carlisle. Republican in name only is probably what Mr. Trump would say. What does Glenn Youngkin, in your conversation yesterday, what does he symbolize to disaffected Republicans right now?
Well, he has a purple state, right? So for him, it's about a balancing act. And yes, he went into the Virginia elections in November almost calling for a referendum on himself. He told David Rubenstein before that election, September, he said, I want to put my record to voters. It also came down to abortion. He was calling for a 15-week limit. Yesterday, he said it wasn't a mistake to talk about abortion in the election, even though you had some Republican delegates talking to the press saying we're running on the third rail of politics. But he said he was outspent by the Democrats when it came to that, and a lot of these races were very close. He's very optimistic about still being able to get a lot done. He only has 2 years left, and can only serve one term. But what he's dealing with is less money. Pandemic aid money has dried up. And he's going into a divided government, even more divided, given the General Assembly is now completely controlled by Democrats in Virginia. And he's looking at potentially what him and his economic council are thinking is a mild recession next year. So this is how he's framing how he's going into next year. And in his purple state, he has to balance, the populists and the neoconservatives of the Republican Party.
Well, take it to the presidential election. Terry Haynes was brilliant on this about 10 days ago. If there's a lot of Republicans out there like Youngkin, perhaps distant from the former president, how does President Biden get them to vote for him?
I don't see these Republicans voting for Biden, even if they're not a fan of Trump. And Governor Youngkin didn't say he wasn't a fan of Trump. He just said, I'm not endorsing anyone until the Virginia delegates make their decision. I'm standing by Virginians. He's very smooth in trying to answer these questions because he's still courted. Some of that buzz has really evaporated given the fact that he didn't flip Virginia red. But individuals, especially donors, really see him as the future of this party. What we're seeing right now in the Republican Party is they're about to nominate a man who is going to be older than Joe Biden was on his inauguration day, who lost the 2020 election. And they're going to see really a generation of Republican executive talent pushed to the side. Glenn Youngkin is term limit. You have Ron DeSantis, Brian Kemp, Mitt Romney is leaving the 7th. People like Speaker McCarthy, people in high-value leadership positions who can do these jobs are leaving. So it remains to be seen what happens. And if Trump were to win, he's only one term. This really sets up a wide field for 2028 for anyone that's willing to stick around.
A wide field on the Republican side. There's a question of how wide the field is on the Democratic side as an increasing number of polls show President Biden on the back foot in a theoretical matchup with the former President Trump. How much sweat is there in the White House right now?
Listen, the White House will tell you, or the campaign at least, because the campaign's the one that's supposed to be talking about the polls, there's obvious concern, but they still have a year out. And President Biden is sitting on a massive war chest of money that they can deploy. And I think at some point, once the Republicans go through their primary, the early to mid next year, they will start to deploy this money. And they're going to go after those issues that they know that can turn out voters. And we've seen it time again. Ohio, Kentucky, Virginia, abortion. You can imagine they're going to spend a tremendous amount of money. I believe he's sitting on $91 million right now. And we have seen in the last few weeks him really ramp up as well those fundraisers. He was in Boston, he was in Vegas, he was in Los Angeles. And you'll see a lot more of that come 2024.
Anne-Marie, just shifting a little bit to the Ukrainian president who's going to be in Washington, D.C., what tangible types of items do you think will come from that? How much pressure to get something passed for aid to Ukraine by year end?
It was around this time last year that President Zelensky was here, and it was triumphant and jubilant, his visit. He was greeted as this war hero. Then he came in September. It was a bit more toned down. Remember, we weren't even sure if he was going to meet with then Speaker Kevin McCarthy. And now it's definitely more of an awkward meeting. Not for the White House, where he'll receive a warm reception, but he's going to have a very tough time in Congress. You already have individuals like Senator J.D. Vance saying Ukraine is one of the most corrupt countries. He's going to meet with Speaker Mike Johnson, who is struggling in the House to see whether or not Republicans would back Ukraine aid. He was elected after they rejected Speaker McCarthy. So this is going to be a tough one for Volodymyr Zelensky. He doesn't want to wade too much into the internal politics of the United States. He's probably not going to touch the issue on the southern border, but he wants to make the case that Ukraine is the last country standing between Russia and a NATO ally. And that is why it's imperative for the United States to continue supporting Ukraine. He said yesterday, standing alongside Lloyd Austin, that the only thing that this helps, this acrimonious nature of what is going on in Congress, this only helps Putin and his sick clique. That's the type of message he's going to deliver today.
AMH, thank you. A big challenge to try and deliver that message, TK. It may well fall on deaf ears.
Well, she went through the last 12 months and the evolution here, and I guess it's like any other war. It starts, it's going to end quickly, and then not.
And fatigue kicks in, and people don't want to support it anymore.
Fatigue, financially fatigue, and I saw a blurb the other day, I'm sorry I can't cite it, where they're literally running out of ammunition in all sorts of European nations. Yeah, I'm using ammunition in an amateur way, but the fatigue, John, that's the right word.
I just wonder, especially as we head into the election, how much there really is a sort of nationalistic focus of voters versus some international heft, whether there still is this feeling that people want to participate on the international stage. And to me, I'm uncertain on that. I've seen conflicting polls about where the focus is, specifically in subsets of the population based on age, based on affiliation, party affiliation. It's one of the big questions.
I think the new isolationism, which I can't characterize because I don't know what it looks like, is partly of the historic isolationism of America. There's no question about that.
Coming up, not on this, on markets, on fixed income, on CPI, on retail sales and the Federal Reserve. Rob Waldner of Invesco. That's coming up shortly. Equity's just about positive on the S&P 500. Yields coming down by 4 or 5 basis points, 418.72. We are 1 hour and about 4 minutes away from inflation data in America. From New York City this morning, good morning. Equities on the S&P going absolutely nowhere, 60 minutes from CPI. Here are the scores on the S&P 500, firmer by 0.1%. On the Nasdaq, up by 0.2. Decent couple of days of gains on the S&P 500, even with that weakness in big tech yesterday. Into the bond market, 2-year, 10-year, 30-year. What a change for the front end of the curve. We were getting used to yields near 5%. Now we're back down to 468.25, down a couple of basis points. When we did the November CPI report 12 months ago, Lisa, we were talking about a 7 handle. We're not doing that anymore.
We're talking about 3.1%, the expectation for headline CPI. And yet what I'm interested in, honestly, is when you go under it and you look at the excluding energy, excluding food, we're looking at a 4% inflation rate that's probably sticky. This is what's causing some angst for the likes of Lindsay Piegza, who's saying you got to be a little concerned about this.
So we've got the data, CPI, then retail sales on Thursday. Then you've got the tug of war between two central banks. You've got to push that through the FX market. The euro against the dollar shaping up as follows. On the euro at the moment, about 108.03 against the dollar. That's a stronger euro, weaker dollar through G10 this morning. That currency pair positive by 0.3%. Lisa, the Federal Reserve, it's going to cut next year, according to pretty much everybody under the sun, with the exception of maybe Lindsay Piegza. The ECB is going to go first. That seems to be the consensus view, which is why up until recently started to see just a little bit of euro weakness coming through the market.
At this point, I do wonder whether parity is a call that a lot of people can get behind, as BNY Mellon's Jeff Yu is talking about, or whether you could see surprising upside at a time when the French stock market just reached another all-time high.
Germany too. I mean, people are talking about weakness. Where is it?
There's been a gross underestimation here, and it's at the data gathering, and it's about the pandemic. And might I point out the shockingly close Ukraine war. So I think it is a jumble. I would go back to the culture, John, and you're going to see this in Davos. The basic idea here that the ECB has to listen to the Bundesbank. The Netherlands electorate in complete turmoil there over the last 12 months. So I would suggest there's a political and cultural overview here that there's not in Washington.
Yeah, the inflation, without a doubt, deeply unpopular in the nations that you just talked about, Tom. And everywhere else as well. Let's get you the top stories under surveillance this morning. We're an hour away from the latest CPI print ahead of tomorrow's Fed decision. Bloomberg Economics expecting headline inflation to remain flat for November with a slight uptick in a monthly read on core. Bloomberg's outlook seeing core inflation falling below 3% in the first half of next year, which is why so many people think, Lisa, rate cuts are just around the corner.
Because you are getting that good disinflation and you can just sort of cut rates in tandem with a disinflationary kind of bent. How much does the Fed chair lean into that? I'm guessing not at all, and I don't think anyone cares.
And if he does push back, precisely, does it matter, Tom? If you get that pushback, you get that so-called hawkish hold from the Federal Reserve tomorrow afternoon.
It's part of it, but I'm going to go to my recent overestimation, or my overweighting, I should say, of the real economy in this new, better productivity. That wasn't in the equation, the mathematics, the soup of it in spring of last year.
Let's get to the latest from corporate America. We've talked about the job cuts, almost 20% of the workforce going over at Hasbro. The holiday shopping season proving to be not great. Here's the latest from Oracle, continuing its fall this morning after posting disappointing results in cloud computing. The software and database company posting 2 consecutive quarters of slower growth as competition builds with Amazon, Microsoft and Alphabet. The chairman, Larry Ellison, defending the outlook, saying demand for cloud services is, quote, over the moon. The question with this stock down 9% this morning, Lisa, is whether this is an Oracle problem or some kind of signal about what's happening elsewhere.
Exactly. Is this a sort of story of the year, which is consolidation among the biggest tech giants of market share, particularly with cloud computing? Or is this the suggestion that maybe companies are spending less? Based on the performance of AWS, Microsoft's Azure, I would say probably this is an issue with Oracle losing some of its market share to the giants, which we've seen consistently throughout the year.
We're exhausted from the soap opera of 4, 5, 6 weeks ago. AI, open AI, close this, whatever it is. And the answer is, you know what? It's about engineering. It's about engineering, what AMD is going to do, Microsoft racing to catch up with NVIDIA, and that's about American technology.
Do you want the last update? Here's the last update. Harvard student newspaper The Crimson reporting President Claudine Gay will remain in office even as pressure builds following last week's Capitol Hill testimony on anti-Semitism. More than 1,000 students and alumni calling for Gay to resign. Another petition in her defense earning the support, Tom, of 700 faculty members.
I want to know where the other 200 schools are, whatever the number is. I'm not informed on that, but I find unseemly the focus on one or two or three schools. There must be a lot of other schools in the same boat, the same debate, and they're just beneath the radar. That's unfortunate.
Amazing, Tom, to see the shift in tone that I've witnessed. The embodiment, I think, of the liberal elite, the establishment, people like Fareed Zakaria over at CNN, with an incredible monologue over the weekend. Neil Ferguson writing this in the Free Press, Tom, on the intellectuals, and the treason of the intellectuals. And this quote at the moment, Tom, I'll read that to you.
Please.
I have also witnessed the willingness of trustees, donors and alumni to tolerate the politicization of American universities by in a liberal coalition of woke progressives. The pushback you're starting to see, Tom, is getting bigger and bigger.
I put this out on Twitter and LinkedIn. It is 10,000 words, and it deserves to be read. And I'm going to go back to a book that was changing for me somewhat like Schindler's List, and that was the Book of Abraham, Marek Halter, the great French philosopher, modern philosopher. And Neil Ferguson uses that heritage, that European and Germanic heritage of an ugly 1920s. I mean, it's a tour de force.
I just hope that this really launches a question around what is free speech. It's not just simply allowing certain speech and not others. Right. It's this question of not having some sort of implicit censorship of different viewpoints and different concepts.
Patiently waiting as we discuss these events, these moments that we're in. Rob Waldner joins us, Chief Fixed Income Strategist, Head of Macro Research at Invesco. Rob, these are delicate conversations, and one of the delicate conversations for Invesco and finance is a 15% bond market loss. That's the drawdown roughly. And there's been a nice recovery this year. Into next year, is there an inertial force where you get a better bond market just because 2023 was better?
Well, Tom, I think it's clear that next year we have the tailwinds behind us for the first time in quite a while in fixed income. So it looks like we'll finish this year in positive territory, which is great, 2023. But in 2024, I think the question is not what direction interest rates are going to go, but how quickly the Fed will cut. So we either have a slow cut, which is based on what you might call maintenance cuts, as the Fed realizes inflation is low and will stay low, or a quick cut, which would happen if the Fed overstood their welcome, kept things too tight, and created a more impactful slowdown in the economy, and they had to move quicker. So we're really on a path of either slow cut or quick cut next year, and both are pretty good for bonds. So valuations are a little bit rich right now, but I think it sets up great for 2024.
So basically, you're leaning into Emily Roland's pivot party. You were invited, and you're playing.
Yeah, absolutely. I mean, we think we're in a slow growth, disinflationary environment, and the data now is pointing to that. I mean, Atlanta GDP now for the fourth quarter is coming in. I think it's 1.2 right now. We get the CPI data today. The market's leaning a little bit, I think, on the bearish side or the low side of the 0.3 that we see as the sort of consensus. So, today there might be a little bit of noise, but clearly, inflation in China is China's in deflation. Inflation in Europe is coming down much faster than most people expected. Inflation in the U.S. is coming down, and we think we're in a continued disinflationary environment.
The question is really, what is the weakness that accompanies it, which really raises the question of, do you go into government debt, or do you go into corporate debt, in particular risky corporate debt, and do you go into some of the small caps and others that are more leveraged to the economy? Given the fact that we're looking at high yield spreads that are the lowest going back almost 2 years, or actually more than a year, there's a question of, have we overpriced the risk of a soft landing?
Well, we've probably, we think the soft landing is the base case, right? So pricing to the soft landing is not a bad thing to do, but we do need to be very cognizant of the potential, a harder landing, a recession. And, certainly credit spreads, particularly in IG, actually, Lisa, are very, very tight. In credit industrials are pretty tight from a spread perspective. But if you go back to an all-in yield perspective, they still look very compelling. And in our base case, where you get this disinflationary, slow growth disinflation this year, I think which all signs are pointing to, that will be good for credit across the board.
Rob, as a civil engineer, you understand partial differentials and partial derivatives. And one of the answers in the yield space is all of a sudden use of cash in the equity space is a challenge. In the next year, are we going to see a migration of middle ground balanced portfolios towards equities if this market expands and away from bonds? Are people going to go for total return of equities over the coupon of yield?
A great question, Tom. And actually, I'll take a slightly different tact at it, which is with the real yields where they are, which is historically extremely attractive, investors will continue to look for the bond market. They can really get a lot of what they need from a term perspective from the bond market. Also, equities will do quite well in the environment that I laid out. So the place where the source of funds is likely to be cash or money market funds, these types of things, which have been very appealing because they have a high yield and very low risk. But they have one risk that, I always say the money market funds and cash have one risk, which is prepayment, reinvestment risk. And so if you get, the bond market doing well, the equity market doing well, that is likely to draw cash off the sidelines into the markets. And we think there's a lot there.
Rob, wonderful to get your view. Thank you, sir. Rob Walden there of Invesco.
Thank you.
Lisa, this is a question of what's the trade of least regret going into 2024 in 12 months' time. I think we've asked this a few times. In 12 months, will you regret not locking in that yield, reinvestment risk? Or will you be happy that you're in cash and you could deploy it on pullbacks on the S&P 500? Given the move we've had in the last month, I think extrapolating that out, you know the answer. But That's the question you've got to ask going into next year.
Where are the dips? This is the problem.
Yes, I haven't seen many.
Yeah, I mean, this is the real issue. If you want to buy on the dip, which is what so many people have been saying for so long, then they wait for the dip and then it's 1% down. Oh my goodness, everybody jumps right in. This is the problem when everyone's been doing the same trade of short-term cash.
I'm going to say something I've never said, and I haven't framed it. And John, I have no evidence. I've never seen a record high Standard & Poor's total return, Dow total return, with less exuberance than we're in right now. I've never seen it. I'll go back and look. Somebody will say, hey, stupid, look at 1990 this, 18 this, whatever. I've never seen such a lack of exuberance.
Is this because we're basically where we were 2 years ago?
I think, yeah, that's a really good point. We've basically gone round trip, and now we're trying to add to that to new record highs. That's a really good one. The 24-month total return is
punishing.
Yeah.
It's been exhausting. If you're just
It's
joining
been
us,
exhausting.
welcome
Absolutely.
to the program. The show continues. Equity futures on the S&P 500 positive here by 0.1%. Yields a little bit lower by 4 or 5 basis points, 418 at 53. The standout corporate story of the last 24 hours. There is a toy maker in America which is cutting 1,100 jobs, almost 20% of the workforce 2 weeks before Christmas. Their stock is down 5% in the pre-market. It's already lost about a third of its value, Lisa, since early September.
I remember when people played Dungeons and Dragons and had My Little Ponies. Look, there's a question here. Is this just an issue of people going to Roblox and that's where kids are? Is this a company that really excelled during the pandemic where everyone was desperate and that is just feeling retracement versus really kind of signaling something that we're going to see in the retail season, especially because there was a report about small business optimism that came out this morning that was worse than expected. So on the margins, you are seeing a feeling that maybe people are running out of patience.
Torsten Slok has his slide. He puts out a slide every morning, folks. I know you guys saw it, and bankruptcies are spiking up. They're not 08 grim, but there they are. And I'm going to go back to two Americas, and I think there's a half of America. They don't care what the grocery price is. They're going to celebrate the holiday season. And there's another group going, wait a minute, how do we get to February?
Well said.
Did I do okay there?
Absolutely, totally agree. Totally agree.
Come back tomorrow?
You can come back tomorrow.
Good.
You can take Friday off. Long weekend for you, TK. Coming up next on the retailers, the 2024 outlook from Bloomberg Intelligence. That's just around the corner from New York City. This is Bloomberg.
Yes, we're seeing inflation slow, but consumers aren't really feeling that right now. And they're still seeing a high level of prices, which is contributing to some of the consumer fatigue that we're starting to see develop and we think will carry on through 2024.
That was Sarah House of Wells Fargo. US CPI data about 45 minutes away. Our survey calling for a slightly lower headline figure. Jennifer Bartashas of Bloomberg Intelligence warning this. Retail staples companies, including Walmart, may face a difficult operating year in 2024 as waning inflation makes same-store sales and top-line growth more difficult. Stand out, I think, communication from corporate America in the last couple of months from the last earnings season, TK, for 3Q, was Walmart using the D word, talking about deflation in our future for their company.
And it followed up after we heard that from their CEO. I mean, John, this is important. This thing has legs to it, where their leadership is looking at what I'm going to be polite and call price flatness. It's tough to grow. It's tough to look at your fixed costs if you've got price level like that. What we're going to do here right now is give you a view to next year, and we do this with two of our outstanding people at Bloomberg Intelligence. Jennifer Bartashas joins us, and Poonam Goyal on your Retail America. Of course, retail sales on Thursday. We'll have all that for you. Jen, let me begin with you. Hasbro, John Ferro mentioning that Hasbro laying off loads of people. They distribute their product through your world. In the toy aisle at Walmart, how grim is it?
Well, it is a weak season for toys, and there are a couple of things happening there. First, the discounts just aren't as high as they were in previous years, according to the price study that we run every week. But also, it's that the consumer is being much more selective. And you have to remember that during the pandemic, people stocked up on a lot of things, like board games or things to keep entertained. So the demand has been a little bit slower, but overall, it still is a weaker season, and that's just reflecting where the consumer is right now.
Poonam, your Amazon note in your outlook is simple. They will battle, they will cut price to their retailers to compete with the other people. How's that going to play out 12 months and even 36 months down the road?
Yeah, I think Amazon will continue to pull share from the brick and mortars, notably as people continue to seek convenience and low prices. What we read and what we've seen in studies is that Amazon actually is priced best compared to most rivals, including Walmart. So that's encouraging and really drives shoppers to its platform again and again. Now, what's interesting is that while toys is off to a slower start because there isn't that many discounts, it was actually a call-out category for Amazon for the Black Friday selling week. It was a popular category. So the demand for toys is there, but people are being selective on where they get them and how they get them.
Poonam, do you see this as the beginning of something greater, basically a trend that can last, especially given the fact that we are seeing deflation when it comes to gas prices, when it comes to some food prices and some good prices?
I think the trend remains. The trend didn't start this year when, consumers started to combat inflation. It's been around for quite some time, whether you look at it in the apparel space or in many of the other discretionary categories where people are making choices. They're figuring out where they can stretch their dollars and really maximize their spending power. So we think that trend is here to stay. What's going to drive spending as we move into 2024 is going to depend on the fashion. It's going to depend on the brands that consumers are seeking. And then on top of that, convenience and price.
Jennifer, from your perspective, how much is this a tale of two consumers? There's one who's looking at different fashions and kind of whether they want to buy that nice item or not. And then there are other people who are seeing what their grocery bill is and deciding whether they can buy extra things, right? I mean, in other words, are you seeing big differences in some of these trends and the weakening depending on which sector of the population different stores deal with?
It's very true. We are still seeing that division of the consumer, and people who are comfortable are going to continue to spend. But what is notable is, and we've heard companies like Walmart talk about this, they're getting trade down customers. So they're getting some of those higher income households coming into Walmart to buy groceries. And part of that just may be that people are looking to save where they can, and then they're splurging where they want to indulge themselves. But then you also have the consumer who is very tightly strapped. And so this is where retailers are really looking at the value play. And that's part of what's going to make it a difficult operating year for these retailers, is that they're going to have to keep prices competitive for a lot of consumers out there.
Jen, to both of you, and you don't do buy, hold, sell at Bloomberg Intelligence, but as a general statement, are your stocks richly valued? In the show this morning, we've heard about PE expansion and the rest. When you wake up, do you go, wow, these things are rich?
I'll start with Amazon. It's the largest company that I cover, and we have argued that the cloud business alone is probably worth more than where Amazon sits today. So it depends on how you look at the businesses and how you value them. But we do think that when you break up or try to break up the pieces of Amazon, there's clear value and growth across each of its segments.
I look, Jen, here again at the big boxes as well. I mean, John, we're looking at Macy's yesterday trading for a cup of coffee. I mean, the competitive landscape, do they just keep growing and growing, earning those 20 multiples?
I think that they do continue to grow in this environment. And if you think about it, they have the greatest touch across the United States. They can touch lots of consumers, but they basically meet the need that's out there. And traditionally, staples are a more defensive sector, and we're in a period of time where value is king. And so these companies, will be rewarded by consumer behavior by virtue of the type of businesses that they run.
Two of the very best. It's always good to catch up with both of you. Bloomberg's Jennifer Bartashis and Poonam Goyal of Bloomberg Intelligence. I was just looking at this everything rally. The airlines, the rally off the low. The low, of course, at the end of October, just after bond yields peaked. Lisa, we've had a move of more than 27% on the airlines, and on the S&P 500.
This comes with the projection for record travel during the December break. This comes as oil prices go lower. This is going to be a huge boon to their potential margins, considering that they're not necessarily hedged in the same way. And third of all, this challenges the idea that people aren't spending. It's just what they are spending on, and it has been a story that has not gone away. Is this something that is going to be sort of a staying secular shift, where people buy fewer things and do more?
We're going to get through the economics, 30 minutes inflation, the Fed, and on to retail sales. And on Friday, somewhere in the vicinity of 4:15, we have to calculate breadth. Are the airlines the kind of breadth that you see to catch up with the Magnificent Seven, or at least close the gap?
The rest of the market, Tom, is doing nicely over the last 24 hours.
It's been undersaid.
Yesterday was a bit of an interesting moment. Whether you think that continues is the bigger
I'd
question,
say,
ultimately, but we saw it.
Liz Ann Saunders at Schwab covers this nicely, and the answer is the breadth is there. It's been there for 30 days. I'll let somebody decide, but it's whispers here, but it keeps going. It's more than a whisper.
I'll just say this, Tom, if you're expecting the consumer to drop off a cliff, we're running pretty hard into that, aren't we, in certain parts of this equity market?
Besides that, we've been wrong for a year. I've been wrong for a year.
Many others have been too. In the next hour, we're going to break down CPI for you. In around about 5-10 minutes' time, we'll catch up with Alicia Levine of BNY Mellon. And then we're going to get a view on the commodity market. Christian Malik's going to join us over at JP Morgan. He's been quite bullish on crude, still is, next year and the year after. It's a 2-year call, a multi-year call from JP Morgan that we need to get into. We'll do that in just a moment. And Lisa, after that, really, I think the energy story, part and parcel of the broader inflation story. The reason why a headline is going to come in and why most people think it will is the energy correction we've seen over the last couple of months.
Which is the reason why people are looking at core, at X energy, X food, because that's going to be such a disinflationary and deflationary kind of force. Here's my question. Are lower oil prices right now a good thing or a bad thing when it comes to the inflation story? It's kind of a subtle point. But on one hand, it's a good thing because it means that the headline inflation number is going to come down and people's expectations for inflation drops, at least in the near term. But it gives people more spending power. It's basically a stimulus check in their wallets.
Isn't that good news?
Okay, but is it good, like just good enough, not good enough?
Oh, you mean...
does it fuel spending more?
We don't want to boost spending too much.
Well, this is sort of the Goldilocks idea, right?
Isn't that a ridiculous moment to be in?
Welcome
we look
to
at low energy
2023.
prices and somehow we're trying to paint that as a bad thing.
Well, I mean, it could be
particularly when it's
weakness.
come from the supply side.
Okay, fair point.
Far
At the
more
same
interesting if you
time-
ask the question about the American economy. Is it a good or a bad thing, considering we now produce more than 13 million barrels a day of the stuff?
I think that it just is a way of thinking about some of the drivers of inflation going forward.
Yeah.
That potentially were set up for the idea that oil prices could rise if there is the sort of supply withdrawal. And that second of all, you're dealing with something that essentially gives consumers more money to go out and keep spending.
Which is
Depends.
It depends. Kind of a good thing.
It depends on
just
the
so long as
context.
they don't come down too much. But if they come down too much because of demand, That's the objective?
Well, basically, you just don't want too much inflation.
It's very confusing stuff, TK.
It is. 1987 today, Christmas movie.
Stop it. You agree.
Yeah. Wall Street.
Understand. You follow. Don't make me feel dumb. Go, carry on.
You're too smart. That's the point.
Stop, Tom. Carry on.
Oh, no, we'll pick it up later. It's too important.
On 1987?
Wall Street. If you need a friend, get a dog. Gordon Gekko.
Okay, nice.
Yeah.
Good
Today.
movie. Today. Nice.
1987.
When you step back and you think about the cumulative inflation, I think that's what a lot of consumers are still feeling.
Inflation may be coming down, but going to the supermarket doesn't feel any better for anybody.
We have a Goldilocks issue here where we don't want them to spend too much, but we want to see activity.
The Fed needs to ensure that inflation is stamped out and will not return, which means caution.
I think that the inflation is going to look a lot less immaculate in Q1.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. Inflation countdown clock at 29 minutes. An important inflation report. John, what part of it do you care about?
Very focused on Town Paper and Blue Star Airlines this morning. We can check them out in the pre-market. Do you like that?
I like that. It's
Wall Street.
Good.
Nice.
Very Wall
nice.
Street. 1987. Nice. Great movie. Margin call as well.
Can you imagine the control room sort of like trying to find the ticket?
they're like
who?
100%. That's what happened.
Can we book Gordon Gekko?
Can we get hold of Gekko?
Can we get him on?
We're going to park that. Let's focus on CPI. The number drops in 29 minutes. So we're seeing signs of a credible slowdown in the economy, not just disinflation. Morgan Stanley says yes. If we are, where does it leave Chairman Powell tomorrow? And a big question for so many people. Forget the data, forget the decision, the statement, the projections. Focus on the tone of the news conference. Does the chairman of the Fed push back against the easing of financial conditions we've seen in the last month or so?
Into what we see in 28 minutes, John, the basic idea here is we've had a glide path. It's in place. And the number of the dispersion of opinions here on how you go from 4 to 3, just as a round number, or 4 to 4.3. Lindsay Piegza, in an hour and a half ago, is looking for a rate increase.
Potentially. The threat of what from this Federal Reserve. So is that a credible threat? Do you think that is a credible threat from this Federal Reserve at the moment? Because this market's not listening, Tom. It's made its own conclusions about the future.
It is part of the probability distribution. It's not a credible threat, but given what events happen, you may see this. And it's still here with the bond market. And Lisa, I go to where we are and go, okay, we go level from here. Is that in the report here in 20 minutes?
Well, if we go level here, is that still the pivot party that everyone's invited to, that Emily Roland was talking about? Is that enough that we just get stability and strength, and at least
stability doesn't do it for the Fed?
Well, it's not necessarily when it comes to inflation, but over the long term, stability in bond yields, because we're basically gaming out that the Fed's going to cut rates, but we still are in a higher rate regime for a longer term. Honestly, to me, what I find interesting is that since rates peaked out in this cycle, on October 19th, around there, that's when you saw the massive broadening out. That's what's fueled everything beside the Magnificent Seven that has gotten serious wind.
Here's the reality. I looked at this. David Rosenberg was brilliant on this 2 or 3 days ago up in Toronto. John, it's simple. I look at the plane flights I look at, and it's rosy. It's wonderful.
It's busy.
Lower prices. It's great. I ordered groceries yesterday off the computer. It was outrageous. I ordered dog food for vet bill. It's outrageous. That's what people are feeling.
A lot of the people in this country, Tom, totally agree with what you just said. Yeah. And yet we're still having a conversation here on Wall Street about rate cuts next year. So let's talk about the rate cuts next year. The 2024 dot at the moment implies 1 cut, Tom, from where we are. A lot of people out there think that perhaps you add in an additional 2. This market, a lot of people in this market looking for 100 basis points plus.
Yeah.
Is direction enough? If the Fed moves towards you but doesn't get there, is that enough?
I think they're going to wait for the data, and we're going to see that here over the next 3 days. Michael McKee with his great leadership on that. The guest is so important. Let's get to the data. I got a bit of green on the screen here. I got a Dow total return record high. SPX within 1% of a total return high, John.
Equities right now positive by 0.1% on the S&P 500. Getting a ton of targets on the S&P for 2024. John Stolfus of Oppenheimer, the most bullish, seeing the S&P ending the year at at 5,200. Alicia Levine at BNY Mellon, not far behind Tom, calling for 5,000, expecting a slow first half and a rally into year-end. Down the other end, TK 4,200 on the S&P. Year-end is the call from Marco Kalanovic and the team over at JP Morgan.
Can't show this enough with the new 5,000 numbers that we're seeing. Joining us now with terrific, rigorous mathematical analysis, Alicia Levine, Head of Investment Strategy, Equity Advisory Solutions, BNY Mellon. I want to talk about Jeffrey Yu's Euro call, but we'll save that for another time. You have a beautiful sentence in your report, cash will underperform. The known worlds in cash. Discuss.
Almost $6 trillion in cash. If you step back and say, what were the trades this year? It was AI, GLP-1s, and cash and T-bills. So the question you say is, if I look into 2024 with an expectation that we're going into a healthy slowdown for the economy, the Fed's going to cut, we think, the second half of the year, not the first half we can discuss, and we have inflation moving in the right direction, where does cash lead you? And it doesn't lead you to the same return you had this year, and this is the time to start reallocating into other assets.
Where does cash go? Individual stocks? Does it go into ETFs? I mean, I'm fascinated within the equity space. Where does BNY Mellon see that the cash will migrate to?
So we think the cash goes to equities. It should be going to bonds, okay? Should be going to bonds, and we're actually calling for a 20% allocation to alternatives as well, because we think this is one of those really...
What's an alternative?
So distressed debt, privates, right? It's a great time for privates, actually, because you're getting the repricing this year into next year, and there's going to be distressed opportunities out there because of the rate hiking cycle. And so that is just a nice setup, and real estate as well, nice setup for an entry of new capital into this asset class.
Before we get stuck into that, just talk to me about cash, how sticky that is at money market funds. When you're making these recommendations to clients, they're jumping on board, still hesitant. What's the tone like?
So clients are receptive to this because with the understanding that what's worked over the last 12 months is likely not to work over the next 12 to 18 months. If you've been in markets long enough, you know that. The same trade doesn't take you far every single year. And on top of that, if we've hit peak rates, we've hit peak Fed, inflation is slowing, cash will underperform the bond market and equities.
Have we seen the distress?
So we haven't seen distress in large cap America. We're going to see it in small cap America and other areas that are reliant on refunding and funding growth. So that means, for instance, the small cap world, that the Russell 2000, 48% are non-earners. They need to borrow to grow. That debt that they're using is floating rate and comes due a lot sooner than the fixed rate debt from the large cap companies that took out loans in 2020 and 2021. So you're setting up a situation where you have some parts of the economy that are relatively insulated, termed out their debt at low rates, like households did with mortgages, and other parts that are more exposed.
Is there any inconsistency in being bullish on risk and also expecting a tick up in distress and bankruptcies?
So there's not an inconsistency because this is not a blanket call, right? The way we've sort of had a rolling recession over the last 12 to 18 months, you're going to get a little bit of that going forward. We do think there's some consolidation in the first half of the year, and actually in an election year when there's an incumbent, there's just a lot of creakiness in the market in the first part of the year as policies get discussed, different sectors are targeted. Right, just you tend to have a bit of a slowdown and probably a digestion. We're going to have a year that's up 22 to 23% by the time we finish the year here. So, unlikely that continues in the next few months. It coincides also with if there's a slowdown, it's the first half of the year. Right, because incumbents tend not to like recessions when they're running for re-election.
Is there anything that we could see in less than a half-hour time that could shake your view on this sort of disinflation that allows this next leg of the cycle?
So it's the core. Right. So energy prices look to be well tamed to the discussion earlier that you all had here about the record pumping of oil and gas in the U.S. and also the warm winters everywhere. So oil prices seem to be well contained. If that's the case, the low oil prices will filter into every other sector. So the core prices today at 4%, we'll see what we get in a few minutes' time. That's where you could get a different narrative if it doesn't come down further. But to the point about whether the Fed cuts or not in March, it's just not realistic. And I'll point out in the last 18 months, the market has been overly optimistic on when the Fed has cutting. If you remember, we were talking about the Fed cutting in August of 22. You know, the market has wanted that Fed cut for 18 months now. It's always been too optimistic for where the Fed's going and where reality is going. And if our call is right, more likely to have a soft landing than a recession, clearly not cutting in March of 2024.
I want to go to your math abilities here. There's a lot of Greek letters getting thrown around right now. Gamma, 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 and the rest of it. Alpha, beta, gamma, epsilon, blah, blah, blah. The skew is silent out there. Explain to our audience the silence that some of these volatility measures show right now.
Boy, 12, a VIX of 12, it's just shocking. But again, the VIX number is really about the volatility in the bond market. And the bond market right now is just well behaved since that CPI report, you know, back in early November. So the whole market for the last 18 months has been driven by the bond market, every other asset class. And as long as that is tamed, the VIX as well will be tamed. But look, it's a risk. It means at 12, it's historically very low.
What would you expect from Chairman Powell tomorrow?
I think it's his one chance to push back.
This is it, right?
It's his one chance. So I would expect something like that, because the easing of financial conditions can't be too pleasing for the Fed in their fight. And they will definitely fight back, I think, against that first half rate cut that we're seeing here. I mean, so, you know, you don't want to say, calling victory too early, but he will definitely fight back here.
It's crystal ball type stuff, so forgive me. But do you think the market listens to him anymore? Is that a credible threat, given what we're all seeing in the data?
You know, the data has been very kind to risk assets. So 8:30 today is really the key. More so CPI than Powell. But I expect Powell to push back against all this excitement. And look, the risk in the market is that everybody's expecting a soft landing, right? That's the risk. Where were we all a year ago? Recession.
A year ago. 2 months ago. 2 months ago, TK.
Did she just say we're going to cash? Is that what I heard? Even off inflation?
You ask me that every time. So we are never in cash because...
Okay, there we go.
That's you told.
A domestic to my right, domestic to my left.
No, but let me just say this. A year ago, you said, so how do you avoid going 5% in cash? And I said, well, we do relative allocations. We never go to cash. And we were over allocated to U.S. large cap. Because if I'm worried about recession, where do I want to be? And that's U.S. large cap. So that was a great allocation for our clients this year.
You wanted to be in the NASDAQ 100 at 48% year to date, which is just absolutely bonkers. That is nuts. Some 48% gain on the NASDAQ 100 year to date.
Well, there's that, but there's also the cumulative gain. I'm going to put it 1 year, 2 years together, and I'm sorry, 1977 rings here. You get a bull market next year, the bears are still out of it. There's a huge number of people out of it.
Yeah, blink and you miss it over the last month.
Yeah.
That's for sure. If you are just joining us, welcome to the program. The S&P 500 shaping up as follows. We look like this. We're positive 0.07%. Yields are lower by 5 basis points, 418.15. Year-to-date gains, Lisa, on the S&P, 20% plus on the S&P 500.
And on the NASDAQ composite, we're looking at 38%. The NASDAQ 100, as you were saying, 48%. These are shocking gains, especially since so many people left the big tech names for dead. What I think is interesting, nobody's willing to say they're not going to invest in big tech or they're going to underweight big tech next year. They'll just broaden out around the margins, but no one is willing to bet against what we saw this year.
Can you bet against the Mag 7, Alicia?
You can trade if you're a trader. Our portfolios are not trading portfolios, but I think it's a mistake. I mean, if you look back since the end of the global financial crisis, go back to 2009, 2010, you had one underperforming year of the Mag 7, and that was in 2022. And that was the regime change year. And we're there. So we got through it. Tech was down 60%. Dance with the one that brought you. You know, tech brought all of us here. So.
All right, 2 items. John Ehrlichman out on Twitter today noting that in 1980 today, Apple stock was issued and the Commonwealth of Massachusetts Secretary of State decided it was too risky for Massachusetts people to own it. And then the other idea, and Apple, Scott Galloway of NYU saying the single thing he ever did was buy that garbage and he never sold it.
Never sold it.
Never sold it.
Love that line. Why have I never heard that before? Dance, the one that brought you.
I love that.
That's brilliant. That's just brilliant. Yeah. I love that. Alicia, thank you.
Thank
you.
Have
a wonderful Christmas. Thank you so much.
Merry
From New York
and happy.
City. To you as well. CPI just around the corner.
Wednesday, the Fed decides.
We're talking rates. We're talking inflation.
Without a recession. That's the good stuff.
Will officials pause as expected?
We're heading into the end of the year. We're in a soft landing right now.
Will they put rate cuts on the table for 2024?
It remains to be seen. The data will dictate that.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Everything was hedged.
They're going to have a good reason to do whatever.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg.
The pressure increases for them to roll these cuts forward through the remainder of the year. Actually, we forecast around 1 million barrel a day surplus for the second quarter and around an overall surplus of about 0.6 million barrels a day through the whole of 2024. So, these cuts do need to be maintained to balance the market through the course of next year. They can balance this market and keep this price at $70 to $80 if they work together.
This was the big call from Citi this year. They just did not see triple-digit crude around the corner. That was Max Layton, the global head of commodities research at Citi. Shout out to Ed Morse for that call early this year. Crude looks like this right now on WTI and Brent. I'll give you some of the scores. WTI $70 and about 50 cents. Brent crude 75.17. We're down by a little more than 1% on both of those contracts. Going into inflation data 13 minutes away. Crude supportive, Tom, in the last month of that disinflationary story we're all talking about.
Fascinating to see. We're going to get right to it right now with the schedule that we've got coming up in 12 minutes. This key inflation report. Michael McKee will join us and the set of worthy guests to interpret the many different parts of CPI in America. Right now on oil, Christian Malik joins us, Managing Director, Global Head of Energy Strategy at JP Morgan. On oil, John, we did this yesterday for you. We missed you so much. A gallon of petrol from the peak down 32%. And I guess that's part of the inflation story. Christian, 2 years ago, you were modeling out oil demand led by emerging markets that would put a bid to oil. Is that theory still in place, that EM and developing economies will find a bid, have stable or increasing demand on oil, and lift the price?
If anything, hey, Tom, I think it's strengthened. There is demand in the world that we just simply cannot see. So when we're trying to modeling demand from a scale of 1 to 10, we're going from 7 to 9, there's demand that's negative that's going to be positive. So in other words, there's demand in the EM world, penetration of energy, poverty that we see today, where they would love to consume any form of energy in order to high grade themselves out of poverty, whether it's lights on the street, whether it's being able to get to work. So that demand, that intrinsic demand that is not visible, is so significant that we don't see demand peaking. I don't think we'll see demand peaking in our lifetimes, particularly as EM demand growth continues to surprise the upside.
Which is really counter consensus, considering people were talking about peak demand for quite a while. Christian, let's go through the outlook that you just put out for next year, talking about how prices could stay around here or go a bit lower, as you do have U.S. production reaching all-time records, offsetting some of the cuts. But then what? What happens in the second half?
Right. Well, it's interesting. I think we've had a lot of discussion around these additional barrels that we don't see necessarily coming from the U.S. shale, coming from deep water. And look, credit where it's due. These guys have done a great job in delivering additional productivity and therefore more production. I think the key point that we make from the second half going into next year is that these are all additional barrels. These are tens of thousands of barrels. They're not millions of barrels. There is no massive quantum of volume that we don't know about that's coming into the market over the next 2 to 3 years. And that ultimately means that it's not if, but when does the market tighten, even as we see potential surprises. So I've obviously seen a lot of discussion around surpluses next year. And we can talk about OPEC, but in the end, the biggest asset test, or litmus test, if you like, in terms of when do we know the market's starting to tighten, when OPEC, led by Saudi, adds volume into the market. That's not a negative, that's a positive.
What's been most surprising to you this year, Christian? Because so many people got the call wrong, that oil prices would be substantially higher. Why are people so confused by what's going on in crude?
It's a great question. I think there's a couple of reasons. Let's just unpack that. First of all, there's a lot of dark inventory led by Russia, Iran, Venezuela, Libya. That is exactly why this time last year we went bearish. Despite our super cycle call, we went bearish into the first half of this year, simply because there's a lot of volume that we just couldn't see. At least with shale, we can see it. This was inventory that was in excess. So that's the first point in terms of the sort of the volatility that we saw. The second is the risk premium, which was introduced through the conflict in the Middle East, where there was concerns around potentially widening of that conflict, and that clearly created a bid to the upside. I don't think the premium's gone away, but it's something we need to keep an eye on. Now, if we're thinking about that in the context of how do we see oil prices going into next year, I think probably the biggest learning curve for us in terms of discovery is the marginal cost for oil. I see a lot of discussion around surpluses and deficits. In some ways, if you want to be critical, you can make it what you want. The reality is what you can't change is the marginal cost of oil. That has gone up. It's gone up significantly. In fact, if you look at the curve structure in the last 7 years, it's basically moved higher over time. And so why is that relevant? Because if the marginal cost of oil is going up, it's getting more expensive to produce, whether it's because of cash return from the majors, supply chain bottlenecks, etc., then we can look at the time when oil went to $70 in April through the banking crisis and take heed from that. That potentially does start to look like a floor. We're in discovery. I'm not going to try to call that as a hard floor, but that to me sounds like a relevant floor as we think about going into next year in terms of the range. And that's why we've talked about 70 to 90 is the range. It'll be volatile. But let's not forget that the marginal cost of oil is going up, and that typically is the early leading indicator of an upcycle.
This confidence, Christian, that you have goes beyond 2024. You and I have talked about this before. Right. Talk to me about why it is that you can make this call and push it out beyond 24 into 25.
There is no significant volume of oil coming to the market into the rest of the decade. All the volume that we know, we can see. If there's additional upside, fair enough, that could create volatility to oil, but there's no major quantum, not like the North Sea in the 80s, not like shale in the last 10 to 12 years. And so with that in mind, it's just a matter of time before the market significantly tightens. And as the market tightens, we expect the second half of the decade will see severe tightening. That is the point where the only real quantum of volume that we can rely on and lean into is OPEC. So when people tell me, oh, OPEC is cutting, it's a bit like the 80s, they're getting weaker, I sort of reverse this and think almost like the art of war here. They're retreating in order to advance. They're going to take share of demand growth in the future when all the big volume out there has diminished. And again, I've stressed big because I'm not saying that we won't see more volume, but not in the millions of barrels that we need to meet that future demand growth, which is at least going to be between 107 and 108 million barrels by 2030, if not higher.
What's the signal that you take from the consolidation that we've seen on the US side of things in places like the Permian?
Yeah, it tells me two things. One, that these companies now struggling to significantly raise productivity on the land they own. So they're having to now pay a premium using paper to gain more land in order to take productivity and efficiencies that they've got, apply it to the land that they've acquired, and raise. So this is definitely a narrative of efficiency. It's a narrative of increased productivity, but it's sort of a double-edged sword. It's telling you that they don't have it themselves in their own portfolio. They're sort of maxed out on productivity, which is clearly bullish, but equally that means that there's more wood to chop on what they've bought in terms of the acreage to raise the productivity to the standard that they're on, for example, Exxon. So while that means we'll see potentially more volume hit the market over the next 2 to 3 years, I wouldn't underestimate the productivity gains. It feels to me as a short duration call to the upside, because what these deals are telling you is that beyond 25, 26, we're now seeing a significant reduction in new inventory that can hit the market. And therefore, I'm not necessarily going to call a peak on shale. Shale will continue to grow. We actually need shale. We don't want prices going very quickly to 150, but shale as a sort of as a basin that's going to grow every year by 1.5 million based on where the oil price. I think those days are over. Now we're sort of in steady state, and we'll see additional volume, but not significant.
Hey, Christian, you're one of the best. Appreciate it, as always. Christian Malik there of JP Morgan on this oil market. Just an update from Harvard University. Lisa, just moments ago, this crossing on Twitter from the Harvard Corporation. In this tumultuous and difficult time, we unanimously stand in support of President Gay. That tweet, that post just dropping on X moments ago.
And it comes after the Crimson, the Harvard newspaper, came out and said that Claudine Gay would remain as president, with 700, I believe, academics supporting her, signing a letter of support. What this does going forward in terms of changes to the policies still is an open question as people look to chart a new path.
Yeah, the pressure Tom, the pushback against this isn't going to go away.
It seems to be school by school, too. It seems to be each school has a different tack, a different emotion, a different culture.
And that's the latest on Harvard and the college education system here in America. Let's get you up to speed on what is still to come this morning. 4 minutes away from a CPI report in the United States of America. Mike McKee's going to give you a preview in just a moment. In the next hour on Bloomberg TV, we'll catch up with Victoria Fernandez of Crossmark, David Leibovitz of JP Morgan, Troy Gajewski of FS Investments to take you into TK the opening bell about an hour from now.
We welcome all of you on Bloomberg Television and Bloomberg Radio here to an inflation report in 3 minutes. Michael McKee joins us now, international economics and inflation correspondent. He's in charge of the inflation countdown clock. Michael McKee, the Bureau of Labor Statistics says they look at 80,000 items for inflation. I think our audience has an understanding of the predictability of jobs, of ADP, even of claims. Is it easy to predict inflation?
It's actually reasonably easy to predict inflation within the contours of what that means. But analysts are generally pretty close to right on when it comes to the inflation forecasts. Prices don't change that much that often, and a lot of them are very visible. So it's not too hard for them to plug these numbers into a computer and come up with a model ID. So we should see something along the lines of what's forecast for today.
On those 80,000 items, Michael McKee, what is the weighting of rent and food, the things we actually spend money on, housing?
Well, rent is over 30% of the index in the CPI, so that's a really big one. It's been coming down. The question is, how fast does it come down? It's been coming down slower than people anticipate. Food also big, and there is a feeling that we may see a bit of a rise in food prices for the month of November, which might be a disappointment to those who were thinking food and gasoline coming down makes the consumer happier. Gasoline prices will be the story today, though, down 6% during the month. But if food prices rise a little bit, that adds a little twist too.
What are the whisper numbers, Michael? We know that we have whisper non-farm payrolls. Are there sort of whisper numbers for the CPI? People sort of ratchet around with recent data.
We don't have a specific whisper number, but the lean on Wall Street is to perhaps a slightly lower CPI than we're anticipating. A higher one would certainly have an impact on the markets as bonds repriced. A lower one might have more of an impact on the futures markets in terms of what the Fed is going to do.
On a correlated basis, John, I would suggest the markets are already celebrating as a small, but it's tangible lift to the markets. Futures up 9 and yields come in nicely.
I think that's the whisper. That is it.
That's the
right
whisper.
there.
I'm looking at it on the
many
Bloomberg.
People, Lisa, this kind of blasé attitude has taken over with inflation with regards to how markets have traded over the last month.
We've seen disinflation, and we've seen more of it than people have expected time and again, and it's international. And we keep talking about that with the ECB and the euro and where it is versus the dollar. But also in the UK, we saw wage growth came in a little bit lower than expected earlier this morning. So people are kind of leaning into that. How big of a surprise to the upside would it take to disrupt this narrative?
It'd have to be a big one, wouldn't it?
It would have to be big.
It really would. So this is what it looks like the next couple of days. In just a moment, in about 30 seconds, you're going to get CPI data in America. Then on to tomorrow, a Federal Reserve decision. After that, retail sales. And then for many of you, Europa. Before we get there, let's get to the equity market on the S&P 500. The scores look like this on the S&P going into this print. Equity futures positive here by 0.2% on the S&P 500. Just a little bit of a lift in the equity market. In the bond market, bid. Massive rally over the last month. Yields lower by 6 basis points on a 10-year to 4.1681. The inflation data just around the corner with a 2-year at 4.66 and down about 4 basis points on the session. With your economic data, here's Mike McKee.
Well, we come in a little bit higher, John, on the CPI headline, up 0.1%. The forecast was for a flat reading, and that's what we'd had the month before. However, base effects come into play, and so we do see a decline in the year-over-year headline to 3.1% from 3.2%. As far as the core, it is what was forecast, 0.3, a slight tick up from last month's 0.2 gain, and so that leaves us at 4% for the month of November on a year-over-year basis, again, what was forecast. So some progress as we go forward with these inflation numbers, but that last mile proving slow for the Fed.
Knee-jerk reaction, in line as a beat. Nothing to change the story. Equities march on, up 0.25% on the S&P 500. In the bond market, the rally continues. Yields lower on a 10-year by 7 basis points, 4.16 on a 2-year, down 5. Session lows at about 4.65 on a 2-year. In the FX market, just a touch more dollar weakness in there against G10 and against the euro. The euro just off session highs of 108.15, largely in line, away from the headline figure, Bramo, and the takeaway for so many is, okay, carry on.
This, to me, is markets looking for a reason to keep on partying. Basically, the Fed pivot party that we were hearing about from Emily Roland, this just sort of, you can lean into it across the board, even though a slight headline beat. The tail risk is off the table, that potentially we could see a reacceleration of inflation ahead of this meeting tomorrow.
Into the Fed. Mike McKee, let's talk about it. Chairman Powell's statement, projections, news conference. What's the guidebook, the playbook, Mike, for you and the team?
Well, he's going to look at these numbers and have a pretty good reason for saying we have made progress, but we're not there yet. So we're going to keep the option open to raise rates in the future. But they're not going to put any timetable on that. And they'll put off any discussion of whether or not they're going to cut rates, because he'll say it's too early for that. I do have some good news here in the breakdown of this. Food prices did not accelerate. They actually dropped a little bit, 0.2 gain for the month for overall food prices, down from 3, and food at home drops to a 0.1 increase from a 0.3 increase. So if you go to the grocery store, prices are a little bit more contained. Gasoline prices, as we anticipated, down 6%. That's the big drag on the overall number. Interesting, though, electricity is up 1.4%. From a 0.3 gain the month before, and I wonder if that's because we go off daylight saving time and people are turning the lights on sooner. Used cars do drop a little bit. Actually, used cars go up, which is what was anticipated, 1.6%. A legacy of the UAW strike. There weren't new cars, so more demand for used cars. New car prices were down 0.1%, and that'll probably reverse. And then apparel. This was one of the areas that Wall Street was looking at for a drop, and it comes in as a 0.3 drop, 1.3% drop on the month. So maybe a little bit of a bonus for people who are looking for Christmas holiday gifts. And then in terms of shelter costs, they were up by 0.4 during the month. That's up a little bit from 0.3, so not exactly as good as the market had hoped.
What we're seeing also is that real wages are going up, and the average hourly earnings and average weekly earnings are increasing. When is this too good news to be true for the longer term? When does this become something that fuels spending? How long can we continue to see immaculate disinflation, which is yet again what we're seeing in this report?
Well, remember, these are based on wage percentages from the prior month, so it doesn't suggest necessarily that we're getting way out of line. 0.8 is better than most months, but it's still the same as we saw the prior month. Now, the weekly earnings were up 0.5%, better than decline that we saw of 0.1 in the prior month. So it probably keeps people spending money. We know that people tend to spend what they earn. And it's less about bonuses and less about government aid. It's more about what your paycheck shows. And so if people are seeing their money goes farther, then maybe they're continuing to spend money. We'll see on Thursday about that.
Mike McKee, thank you, sir. Always great to get the breakdown from you on the economic data. Mike McKee there breaking down CPI. Here's the breakdown of the price action. Equities fade just a touch. Still positive by 0.1% on the S&P 500. Nothing in this, though, Tom, to change your mind. Whatever you thought yesterday, there's nothing here to change your mind from that.
I'm looking at the micro moves here, John, and I think that's correct. We did see a beneficial spike down indicating more disinflation, but critically we did not go through, depending on the series, support or resistance levels of 5, 6, 8 days ago. We didn't see the 10-year real yield break down under where it was in the celebration of December 6 and December 7. So guess what? We await more data, and I believe in the next 48 hours we get more data.
Retail sales on Thursday, and then it's on to the Federal Reserve, Tom, tomorrow before that.
Yeah, we'll have to see just off those meetings as well. What we have is a lift in the market. The levels are so important, and we haven't really done that today. 46.81, Standard & Poor's 500, Dow 36,900, knocking on 37,000. The NASDAQ 100 16,470 is a shocking number. John mentioning up 40% for the year there. I think that's a bull market. Dana Peterson knows a bull market when she sees it. Chief economist at the Conference Board with wonderful perception on the American consumer. Dana, how do you link a quiescent inflation report like this over to retail sales on Thursday?
Well, I think the key thing is that we are seeing inflation slowing, and it's consistent with what the Fed expects. But as was mentioned earlier, real wages are rising, and certainly it's supporting consumer spending. But when we ask consumers how they feel, they're still complaining about inflation. They're still saying that everything's too expensive. Interest rates are rising, so that means if you wanted to buy that car or refrigerator, it's going to cost more. So I would expect that even though real wages are rising, inflation is still there, and consumers are probably going to start pulling back on spending.
How are real wages doing? And within that, are they part? I mean, is it almost circuitous where they're actually part of the inflation report as we adjust for inflation with wages?
Well, I think wages are a part of the inflation story. Certainly, you have a number of industries that are experiencing labor shortages. And when you look at their wages, nominal and real, they're still rising pretty quickly. And I think that's showing up in the services aspect. Let's also not forget that insurance costs are rising because many of these insurance companies are suffering losses and they're raising premiums. So between insurance and wages, we still have these sticky inflation measures. And I don't think that's going to go away right away.
So, Dana, do you think that people are a little bit overzealous about this idea that the Fed is going to cut rates significantly next year?
I think they are. Indeed, the Fed tomorrow is probably going to signal, yes, it's done, but don't expect rate cuts anytime soon, and don't expect that many next year. We think anywhere from 50 to 100 basis points probably makes sense, especially if inflation, according to the SEP, doesn't get beyond 2% before the end of next year. So I still think that, yes, we can get to 2% by the end of next year, but that's really going to suggest that not many interest rate cuts are priced in.
Was transitory right, Dana? Are we just basically seeing the right sizing of the supply side after the pandemic, and that's entirely what we're seeing now? Or is this disinflation transitory? Is this basically a period of a head fake before some of the stickier elements take place in a more significant way?
Well, I don't know why people are surprised that inflation gauges are slowing. The Fed did raise rates by 525 basis points. This is part of the program. Certainly, we saw the housing market slow first, and that's showing up with a significant lag in the rental components of the CPI and the PCE deflator. So that's slowing things down. Certainly, food and energy prices are determined by things external, and we don't have the massive disruptions from OPEC or even wars affecting energy prices, so they're coming off. But you still have the influence of insurance costs and wages because labor shortages are here. And I think that's going to be, those two things are going to be the challenge to getting inflation back to 2%. But we can still get there.
Dana Peterson, well, this is the conference board. Dana, please stay with us. We're going to come right back. A market check here because you saw a spike, whichever way your series going, and we sort of given it back. S&P futures had a nice pop. They've given it back up 6 right now. Same thing in the yield space. The 10-year yield 4.21%. I noticed the real yield was a 197. It's come back nicely, 2.01. Perhaps we're already on the way to adjusting for the Fed meeting tomorrow. Dana Peterson, what is nominal GDP? How about Chairman Powell? He watches every morning. What's your estimate here of the animal spirit of Chairman Powell's America?
Well, I think, nominal GDP is certainly, nominal and real GDP are probably not going to be as strong as what we saw in the third quarter. We're probably looking at growth around, 1% in real terms and roughly 4% in nominal terms, right? Adding in, roughly 3% headline inflation. So that's a slowing economy. And I think, again, that's part of the program. The Fed wants to see the economy slow to help bring down inflation. Now, when we look at business investment, that's already slowing outside of manufacturing, where companies are bringing back product and production and they're building factories. Away from that, there's really not that much investment. The last shoe to drop has to be the consumer. And we know consumers are more indebted now. Their interest rates on their credit cards are higher. Student loan payments are coming back. And, consumers are quitting less and they're thinking, well, maybe the labor market's going to slow, so maybe I should also slow my spending as well.
Dana, I'm just curious. We're seeing that shelter prices pretty much offset the decline from oil prices. Is that sustainable, or do you think that this is just sort of a lag before we start to see housing costs inflect downward?
Well, I don't really look at the month-on-month for housing. I look at the year-on-year. And year-on-year, the rental components are slowing, and it's consistent with an 18-month lag of the Case-Shiller Home Price Index. So we're seeing this happen. Month-to-month, you're going to have bumpiness, but it's a year-on-year growth rate or rate of inflation that we should be paying attention to in terms of what's driving headline and core inflation in the PCE deflator.
Dana Peterson, thank you for the brief. With the conference board and onto the Fed tomorrow in retail sales, always important at the conference board on Thursday. In the markets, there's any number of ways to go here. We've got futures. They ebb back. We had the spike up, the big move, Lisa. We come back. Dollar fractionally weaker as well. There is a pulse to the market. I don't want to underplay it. But certainly we did not get the drama of a CPI report as some expected.
We didn't get the tail risk, which was an upside surprise, particularly in core. It was in line, and that was enough to set this sort of pivot party on its trajectory upward. I just do want to say, yesterday the S&P closed at the highest level in 20 months. I mean, we're talking about a real kind of momentum that this doesn't lean against in any way.
And I don't see the exuberance. And the note was made that the total return index, this is throwing in dividends and all that, of the Dow's a record high, and SPX is T-Suite's 1% away as well. Right now, futures up to fractional, up 0.1%.
And now it's over to Fed Chair Jay Powell. What does he do with this? Does he basically say that this shows progress, but there's clearly more to do and be promptly ignored? Or will he say there has been a real easing in financial conditions, and we're concerned that this could actually work against the progress that we're seeing? That could potentially shift things a little bit.
Well, I think it can shift things. What's so impressive to me is it was, a Midland report. Does he come out with a Midland press conference? What is the... If it's not a snooze fest or a non-event, but if he doesn't give a tendency, isn't that just more ambiguity into the end of the year?
If he does not push back actively against the sort of easing in financial conditions, the rally that we've seen in stocks and bonds, that will be viewed as the starting gun to an even greater rally, because people will say, all right, let's go. There's no reason why he'll push back now.
This is fun. Thanks to Mike McKee for his leadership. He'll be with us, of course, tomorrow and under our retail sales. On Thursday as well, our leadership will be about the equity markets. Coming up, Gina Martin Adams, she was brilliant on the real economy, the misunderestimation of how corporations adapt. And Ira Jersey will join us, these two wonderful guests, to give you a perspective. Here, futures up 9, they come back flat futures right now. Unch is what the pro say. Unch is for unchanged, Lisa. Thank you. I nailed that.
Fantastic.
Unch, the VIX 12.42. From New York on radio and television, Bloomberg Surveillance. Stay with us.
The earnings recession has largely happened. We've had rolling industry recessions. I don't think even if in a slower growth environment from an economic perspective, we're likely to see another big hit to earnings. I don't expect to see the Magnificent Seven crater in 2024. I believe that stocks can outperform and will outperform cash in 2024.
That was Kate Moore, head of thematic strategy of BlackRock, yesterday, leading into this idea of stocks outperforming in 2024. This is Bloomberg Surveillance. Tom Keene, Jonathan Ferro, Lisa Abramowicz, John Zoff. Preparing for the open. We did just get CPI. It came in pretty much in line with expectations. Markets bouncing around, retracing some of what we just saw, Tom, given the fact that people are parsing below the surface, realizing that, okay, it was pretty much in line, but there were some things like used car prices and shelter that surprised a bit to the upside.
Right on the screen right now, we were up 9, I think, at the peak here, a celebration of CPI, and there's some new analysis. And frankly, I would suggest people have leapt right onto the Fed meeting as well. We'll talk to two worthy guests here in a moment. Can I give you a mover?
Yeah, please.
From long ago and far away. Amy, give me this banner. I think it's so important. What a delicate interview you and I had with John in London with Kathy Wood of ARC. And she has surged off our London visit up 37% since our London sojourn. And that's an example. It's not Magnificent Seven. She's in a lot of other stuff and some tech unprofitables. But that's the, not whiplash, but just the surge we've seen in this new, now SPX near record high.
Yeah, it's the everything rally fueled by the disinflation narrative and the sort of soft landing hopes and dream that are becoming increasingly reality. I do want to just bring this to you from Neil Dutta over at Renaissance Macro, saying core inflation did come in line with expectations despite a 1.6% increase in used car and truck prices. That's unlikely to persist in the coming months. Room for downside on core inflation ahead, maybe fueling some of the hopes that have been baked into the market. Joining us now, Ira Jersey, Chief U.S. strategist on interest rates for Bloomberg Intelligence. What do you take just in terms of both the actual report and the market reaction, Ira?
Yeah, so I think the market reaction was just that the data wasn't much weaker than expected. You know, going into this, we had some weak data out of Europe overnight. We had weak wage data in the UK. So you saw kind of an everything government bond rally going into the number. And then the number came out and it was kind of meh, pretty much as expected. Some of the details are interesting, but I don't think it's really going to move the Fed. But I think the impetus for the Fed to be more dovish tomorrow because of this is off the table. And that's why you've seen like TIPS yields, as Tom was mentioning, real yields were under 2% in the 10-year space. Now they're a little bit above 2%. And I think that people are just setting up to be flat going into tomorrow's FOMC meeting.
Where's an appropriate real yield, Ira Jersey? I've heard 1.5. I've also heard 2.1, 2.2%. Where do you think is a efficacious inflation-adjusted yield for the chairman?
Yeah, well, I think he would probably like to have it somewhere between 1.5 and 2%. And obviously we're pretty close to there. I think the thing for the market and what the market's going to be pricing is, is the Federal Reserve going to be able to cut to below 4%? Because right now we're pricing for the terminal target rate for the Fed funds to be during the next cycle 4%. If it's going to be below that, then you can certainly see 10-year real yields down toward 1 and maybe even under 1% by the time we get to the trough in the Fed funds rate in the next cycle.
Is your space, Ira Jersey, driving the stock market? Are you driving the space that Gina Martin Adams lives in?
Well, I'll let Gina talk about that, but it certainly seems that on many days, in particular, I think when interest rates are moving higher, I think that is a headwind to risk asset markets. So on a lot of days when you see, interest rates up by 10, 15, 20 basis points, you definitely see weakness, throughout the entire risk complex. Part of this, I think, is just the idea that all markets are almost correlated now, and that's a symptom, I think, of what central banks have done with their balance sheet, with QE, with quantitative tightening now, where it's that when Treasury prices are down, stock prices might be down as well.
Some real volatility are red on the screen and now up fractionally up 1 point. Dow up 68 points, a VIX 12.42. Ira Jersey, thank you so much. She was absolutely brilliant the last time she was on. Gina Martin Adams drives all of our equity strategy at Bloomberg Intelligence. Gina, I want to go right back to your insight the last time around. How is the real economy, revenues and earnings, and a buoyant stock market reacting to all this fixed income chat?
Well, I think that the market reaction this year tells you everything you need to know. Large caps are rallying even though yields have risen this year. And that's because earnings have recovered after the recession that they went through in 2022. So when we look at the outlook for next year, I don't think it's all about rates. I think rates are a component of what moves equity markets and certainly do impact valuations. But ultimately, the outcomes of 2024 will probably be determined by the degree to which companies can surprise on the upside. Very, very low earnings expectations. The market narrative still is the U.S. economy is flirting with, if not maybe going to fall into recession. And yet the corporate earnings stream continues to recover, posting relatively solid growth in the third quarter, expected to show acceleration in growth throughout the year ahead. This is certainly going to take the market by surprise if it does happen, if the consensus of analysts is correct. That's not in the price. What is in the price, though, is what the bond market is telling us with respect to rates. So we could see if the bond market is wrong and the Fed is not going to reduce interest rates to any degree next year, or even to the degree expected by the bond market, that certainly could impact the equity market. But I think that earnings are also important.
Gina, just to sort of develop that a little bit more, are you saying that a lot of these inflation reads, even retail sales, a lot of stock investors are going to be looking more for the tail risks, more for confirmation that there isn't some either extraordinary weakness or extraordinary inflationary bent to just get even more bullish, right? Basically, the idea of what isn't happening, get it confirmed, and then keep going.
Yeah, I do think that the trouble that we have in the market right now is that for 2 years we've been talking about this weakness. And so the equity market has been conditioned and trained to expect persistent weakness in the economy with some inflation pressure, and the Fed therefore responding to inflation. And anything that is contrary to that sort of central set of the narrative is going to move the equity market. So I think you're spot on, Lisa. It really is about where are expectations, where are prices today, what do prices reflect with respect to those expectations, and then any shocks to those expectations do move the needle.
Gina, give me the breadth update here. You've hit a home run this year in terms of, hey, folks, you got to be in the market. All that cash is out there. Alicia Levine at BNY Mellon says, stop with the cash. Get into the market. What's the breadth going to look like?
Well, look, I think that this is a little bit of an overdone story. Certainly the Magnificent Seven have had the strongest gains in the S&P 500, and because they are the biggest market cap components of the S&P 500, a lot of the gains in the index are attributed to these stocks. But we're sitting in a situation where roughly 65% of the stocks on the S&P 500 are trading above their 200-day moving average. So we've got plenty of participation in this market. Where we need to see more participation is really in the small cap index. This has been an anomaly, and certainly very contrary to historical experience. You very rarely see large caps rip like this with pretty strong participation. Even if leadership is concentrated, participation is very firm. And we're not seeing that in small caps yet. So what I would expect to see in 2024, if our theory of a broadening recovery sort of plays out into next year, is small caps should start to participate. And that certainly will take the entire consensus narrative by surprise.
Gina Martin-Adams, thank you so much. Ira Jersey, thank you so much to all our guests today as we looked at a interesting, I'm going to call it an inflation report of stability as well. Lisa, not a small issue, but before we hear from Chairman Powell, we have to look at industrial business inflation. The world used to stop 30 years ago. PPI was more important than CPI.
Yeah.
And I'm not going to say that now, but nevertheless, there are those numbers with a disinflationary trend. PPI, ex-food, energy, trade, the Dodgers, Ohtani deal, ex all that, 2.9% down to 2.8%.
And the gap between PPI and CPI gives you a sense of what some of those margins might look like in corporate America, to Gina Martin-Adams' point.
Well said.
Right?
Yeah.
I mean, basically,
Huge
this
deal.
is how much can stores keep marking up prices despite the fact that their prices are going down. And if they can keep increasing the price, what does that tell you about the strength of the consumer?
The market churning here. I mean, there's no other way to put it. I got a true red and green on the screen tape. The VIX 12.46. I don't know what to do with the VIX. Alicia was dead on about that. Yields, where were we? In 6 basis points, in 9 basis points. Yields now flat. I got a 2-year yield fractionally higher, 4.73%. What I would do, I would stay with Bloomberg Radio and Bloomberg Television through the day in nuanced, in different markets, and of course to the Fed meeting tomorrow. From PGIM, David Hunt, their president, at 3:30 this afternoon.